Call the meeting to order. I guess any legislators on Zoom, would you please identify yourself? Or is it just, go ahead.
It's Senator Matt Lusser from Connecticut.
Assemblyman Ken Cooley in California. Morning, Matt.
Morning.
Representative Representative Peggy Mayfield in Indiana.
Morning. Anyone else? Okay. Can I get a motion to waive the quorum requirement?
So move.
How about a second?
Second.
All right. All in favor? Aye.
Aye.
All opposed? All right. Can I get a motion to approve the March 8th, 2020 committee meeting minutes?
I would so move. Second.
Can I get a second?
Aye.
All right. All in favor?
Aye.
Any opposed? All right. Well, we'll start by.
Mr. Chairman, can I abstain?
Sure.
Thank you.
No problem. All right. Will, just for clarity, do we have any legislators in the room?
Matt Lehman is there.
I will quickly just announce the legislators present. We have Representative Lehman, Senator Utke, Senator Hackett, Representative Gooch, Representative Oliverson, Representative Lewis, and Representative Fisher, and Senator Talbot.
Okay. Good enough. All right, so we'll start by consideration of the NCOIL Model Act concerning the statutory thresholds for settlements involving minors. Rep. Fisher, you want to start by making any remarks?
Thank you, Mr. Chairman. Before I proceed, I would like to thank everyone who has worked on this model over the past 2 sessions. And I look forward to the committee proceeding with a vote on this model today. It's fairly straightforward, very common sense piece of legislation, and addresses an important issue. The model would apply to situations where minimal amounts are involved with settlements involving a minor, and the parties engaged want to settle that case without incurring additional costs for going into court and obtaining approval. That is a very expensive process. This bill is similar to many laws in states that allow for settling small estates by using affidavits. There are certain security measures in place to ensure that the settlement will be preserved for the benefit of the minor child. By settling through affidavit, the model would allow both parties in the matter to settle the case quickly and allow the people who are injured to get their money faster. Now, before I proceed with this vote, I would like to make one minor amendment. Both myself and my colleague and co-sponsor, Representative Oliverson of the model, would like to make this motion. In section 3A and 3B, we propose that language be included to provide the settlement payor with the flexibility in regards to the type of payment made, not requiring cash, but also allowing payment by check or draft. So after the word cash in both 3A and 3B, we would add or the words or by draft. So I would like to make that motion on the floor to make that amendment. It's a technical amendment.
All right.
Second.
All in favor?
Aye.
Anybody
Aye.
opposed?
Well, thank you.
All right, the motion is adopted. Amendment is adopted, I'm sorry.
I think,
All right.
Mr. Chairman, I think I've explained the bill as amendment, and I would make a motion to adopt the model bill. Is there any questions? All right, yield to.
Make a second.
All right, there's been a motion and a second to adopt the bill as amended. All in favor?
Mr. Chairman, I'm sorry. I know we had a couple interested parties just
right.
lined up to speak.
All right, well, I tell you what, let's have some discussion. Does Representative Oliverson want to make any remarks?
Thank you, Mr. Chair. It's been my pleasure to work with Representative Fisher on this model legislation. I think this is a smart, getting rid of unnecessary government type model bill, which I'm always in favor of, and I look forward to NCOIL adopting it.
Thank you. Good to hear your voice, Rep. All right, we have some interested parties. I think we have Mr. O'Brien who would like to speak on the amendment or on the bill.
Thank you, Mr. Chairman, members of the committee. This is a piece of legislation that at the end of the day shows the value of NCOIL. This is a good piece of consumer legislation that combines flexibility with consumer protection. It is in keeping with NCOIL's innovation agenda. And it's the type of issue that only NCOIL, because of its expertise on insurance-related matters, would focus on. So we thank the sponsors, we thank the committee, and we look forward to this model being adopted. Thank you, Mr. Chairman.
Thank you. All right, Mr. Kirkner, are you there?
Yes, Mr. Chairman. Good
Floor
morning,
is
Andrew
yours.
Kirkner on behalf of the National Association of Mutual Insurance Companies. I had planned to talk for about a minute. I think I'll cut that down to about 15 seconds. Just want to thank you, Mr. Chairman, and the committee and the bill sponsors for their work on this bill. Our membership is supportive. We think this bill will increase efficiency, certainly provide a benefit to consumers, and also protect those minors who enter into settlements. Also want to thank the sponsors for the inclusion of the technical amendments to this bill. We also have submitted a written statement as well. So thank you, Mr. Chairman, and thank you, committee.
Thank you. Are there any other comments or questions from the legislators?
This is Ken, Representative Jordan. I just want to note, I think the expanding this language so that use of draft as an alternative actually gives flexibility, and it is an important safeguard to just not have your handcuff either cash or the attorney trust funds, which is also an alternative. So I think we've added some commercial realism, which does have practical benefits in terms of the manner in which the payout is made. I think that was a very good amendment.
I agree. Any other comments from legislators? None? Yeah, I want to echo those statements because look, as a practicing attorney, and I've dealt with minor settlements, I do know that not only can it be costly, but it certainly is time consuming because you usually have to get on a judge's calendar. And with the pandemic going on right now, sometimes that can be very difficult. It can be months before you get in to see a judge or get somebody to sign off. So I appreciate what you guys have done, and think it's a very good bill. So I agree with all the previous statements. All right, now I think it's time. Can we get a vote on the bill as amended? We have a motion?
So do we already have the motion in the second?
I think we have the motion in a second already. So I think we
Right,
just need to vote.
So aye.
Yeah. There you go. Anybody opposed? The ayes have it. Can we get a voice vote from those in the room? I just didn't hear anybody other than Assemblyman Cooley.
Aye.
Thank you. All right.
That's good.
All right. Good. We'll move on now to the discussion of the NCOIL Insurer Division Model Act. Senator Lesser, are you there?
I am.
All right, let's go ahead and with an introduction of the model.
I thank you, Mr. Chairman. I just want to say a few words before we begin. As you know, NCOIL adopted an Insurance Business Transfer IBT Model Act in March. like the IBT Model Act corporate division statutes, address the significant limitations in the current methods available to insurers to transfer or assume blocks of insurance business in an efficient and cost-effective manner that provides needed legal finality. In 2017, Connecticut was the first state to enact an insurance-specific corporate division law. Since then, other states have followed, including Illinois, Michigan, Iowa, and Georgia. IBT and insurance divisions are similar in some respects, but there are distinct restructuring mechanisms with different functions between the two. Accordingly, following the adoption of our IBT Model Act, I think it makes sense that there should not be one model without another for states to consider adopting. I'm proud to sponsor the model, and I look forward to discussing and developing it with all of you throughout the next several months. And I'll turn it back over to you, Mr. Chairman. Thank you for giving me the time.
No problem. Thank you. All right. Do we have Kathy Belfi or Jared Koski from the Connecticut Insurance Department?
Yeah, this is Jared Koski. Can everybody hear me?
Yes.
Okay, great. Thank you. And Kathy Belfi is on with me.
I am. Thank you.
Thanks, Kathy. So thank you for having us today. Again, my name is Jared Koski. I'm the General Counsel with the Connecticut Insurance Department. And Kathy Belfi is also with the department. She is the Director of our Financial Regulation Division. So I just wanted to provide some background with regards to the Connecticut Insurance Divisions Act that Senator Lesser mentioned to you all, and just kind of give you all a flavor of what we have, general overview of it, discuss kind of our current status, and note just the few differences that do exist between the act that Connecticut has and the NCOIL model that is being proposed for you all today. So just a general history to kind of piggyback on what Senator Lesser had already said. So a few years back, then Governor Daniel Malloy's administration had requested legislative proposals as part of an initiative to enact business-friendly laws in Connecticut. And under this initiative, the insurance industry, primarily spearheaded by the Hartford, drafted and proposed a bill that sought to permit insurance company divisions. This particular bill was based upon existing corporate divisions laws that had already existed in Arizona and Pennsylvania, but in this case for Connecticut was specific to the insurance industry. And as Senator Lesser started to mention, the purpose behind this proposal was that the U.S. insurance regulatory framework offered limited options to insurers that desired to achieve legal and economic finality when the insurer changed its business strategy, internally reorganized, or exits or acquires a line or block of insurance business. So the intent of this bill, again, was to promote the efficient allocation of capital and better alignment of the insurance risks with an insurer's current business strategy and dedicated management. That bill ultimately passed. It is now Connecticut's Insurance Division Act, and it became effective in 2017. So that's a bit of a history of what we have in Connecticut. As a general overview, the Act seeks to provide, again, legal and economic finality to the reorganization and transfer of insurance risks in order to benefit insurers, reinsurers, and from our standpoint, most importantly, the policyholders, because as a department, our main charge is consumer protection. So the Act does this by authorizing an insurer to divide into two or more insurers in a corporate level transaction that is in essence the reverse of a merger. So instead of two or more insurers being merged into one insurer, as happens in a merger, what happens here is that you have one existing domestic insurer that is divided into two or more resulting insurers. So as part of that division, the assets and obligations, including the insurance policies of the dividing insurer, are allocated to the resulting insurers as provided in the plan of division that's submitted. Those resulting insurers are deemed to be the legal successors of the dividing insurer, and the assets and obligations are allocated to them as a result of succession and not by direct or indirect transfer. So from our standpoint, the insurance regulatory issues in the divisions are akin to those that we see in a merger. And that's why the provisions of the Act regarding our regulatory review of a division are similar to those that are applicable to a merger. And I think you see that in the draft that is before all of you in the NCOIL model. Furthermore, if a division is part of a larger transaction that also involves a change of control of an insurer, that change of control will also require regulatory approval under our usual standards and procedures. In that case, it is our Form A procedures, which we as regulators have been doing for a while now and are very familiar with. So that's, again, an overview of what these divisions do. As for a current status right now, although we've received a number of inquiries from companies interested in making use of the Divisions Act, we have not yet received an application or have gone through that regulatory process of one. What we've heard from the industry participants and what we see regarding this lack of activity, I think kind of comes down to two primary reasons. One of which is in Connecticut, a little bit different than some of the other states that have the Divisions Act, and a little bit different than what is before you in the NCOIL model, and I could talk about that difference later on. We have some very narrow language as to who can make use of our Divisions Act, and then who ultimately the resulting insurers are to be. What I mean by that is only domestic insurers may make use of it, but the resulting insurers under the act that we have must also be domestic insurers. So that's something that's different we have in Connecticut versus others, and that may be some reason that narrow language or that we've seen a lack of activity. The second reason I think is just the general uncertainty in the industry around the newness and ongoing review of these restructuring mechanisms, both divisions and IBTs on a national level. The NAIC has established a working group to review these mechanisms. So there does seem to be a bit of a wait and see approach happening in the industry right now. I'm going to skip over some of the key elements. If there's questions about that, I can talk about that. But I just also wanted to highlight, just so everybody knows, sort of some of the differences that there are between what we have in Connecticut and the NCOIL model before you. The draft before you, in looking at it, seems to follow, it tracks very, very closely to what we have in Connecticut with just a few minor differences. One of which, as I said before, is this issue of the resulting insurer following a division in Connecticut must also be a Connecticut domestic. In the model before you in sections 3 and in section 12, it talks about the ability for that resulting insurer to be a domestic from another jurisdiction. Another key difference that is in the NCOIL model is in the standards by which the insurance commissioner must approve a transaction. In the NCOIL model, you all have an additional standard that guarantee association coverage must be part of that standard for approval. And then the third major difference I see is that the notice requirement. We in Connecticut have a notice and hearing requirement, but that notice requirement is sort of strictly related to the hearing itself. Some people can correct me if I'm wrong, but when I read the language in the NCOIL model regarding notice, it does seem broader. It does seem to allow for greater notice to policyholders themselves and perhaps reinsurers. So I just wanted to kind of highlight those differences between Connecticut and the NCOIL model. And Kathy, do you have anything else to add from Connecticut's perspective?
Well, Jared, thank you. You said an awful lot. I'll just add from the practical view, as I would be the regulator looking at these transactions. I want to thank the folks that put this model act together. I think it was very thoughtful, and Connecticut feels good with what you have before you. I just wanted to talk about two two key issues, I think, that are in the act that have been a lot of discussion with insurance regulators. And the first one is transparency through a public hearing. As Jared had mentioned, this division's bill is very similar to what we already do. And all of our change of controls and our mergers are done for the most part through public hearings. And we think that is very important to have within the act. Transparency is extremely important. And then the use of a contract expert. There was a lot of controversy, and there may be talk on this panel about it, that the commissioner has the discretion to use a contract expert. And the key word is the commissioner may. There are some that feel that the commissioner has to use a contract expert. And we feel we have decades of experience that we know when we have to use a contract expert or not. And as you all know, contract experts are very good when they're needed. This is I'll give you a public example. We've had many health mergers, and we've had to use economic contract experts. And I've had transactions where I've probably done 50 transactions where I felt very comfortable that department staff could fully evaluate the transaction and either disapprove or approve. So keeping commissioner discretion is, we think, is extremely important in this act, because ultimately contract experts, we know, are expensive. And ultimately, we look to continue to our best for the consumer, what is best for the consumer, and we just don't think in many cases it would be efficient. Thank you, Jared. That's it. I'll stop.
Thank you. I think Assemblyman Cooley, are you there?
Yes, I am. Good morning, all. Senator Lesser, thank you very much for bringing this model forward. I think it's actually very, very important that we have mechanisms in place to allow insurance enterprises to evolve and manage their exposure in the marketplace. We are in very challenging times. This is a very down in the weeds sort of observation. I think we NCOIL will want to go back and look at our Guarantee Fund Act, our model. The basic rule is, okay, we protect consumers by solvency protection, make sure carriers are healthy, of which this bill fits into that piece. And then the second line of defense, always for the policyholders, is guarantee funds. If ever their carrier runs into trouble, they have coverage. We want to make sure that in this model, and also for that matter in the Post-Assessment Property and Liability Insurance Guarantee Association, in some of these measures, that as we envision the potential that some piece of the book of business may get transformed, that the guarantee fund protection will still follow the customer, that there's no downturn. And that you can get into this, I think, a little bit of an issue because the way terms get defined in the Guarantee Act as to who has coverage and not, and under what circumstances. So I think we just need to make sure that NCOIL is speaking with a common voice across the Guarantee Fund Acts and acts like this measure, which I think meet a marketplace need. So I'm actually very supportive. I just want to say, I think we need to go back and examine our guarantee model and ask ourselves, is there any tweaks that we want to make so that the customer's expectancy is always met? I know this would be the concern for the insurance departments as well. I don't think it's a problem at all. It's just making sure that the technical terminology used in all these acts harmonizes seamlessly. So very good act, Senator. Thank you very much for bringing it forward.
Thank you. Is Ms. Bridget Dunn from Talcott Resolutions? Is she prepared to speak?
I'm here, Mr. Chairman.
The floor is yours.
Thank you. Thank you so much for inviting me to speak today. My name is Bridget Dunn, and I'm Head of Government Affairs at Talcott Resolution. Telco Resolution was a company that was formed in May of 2018 after the purchase of the Hartford's closed block of life and annuity insurance. We are privately owned, and we have been working in the last 2 years to set up our company and stand it up, but also to establish ourselves as a strategic risk partner for the insurance industry. And it's been effective. Earlier this week, the Hartford Courant named Telco the #1 mid-sized company in Connecticut for the second year in a row. And Telco is poised for growth. We've built a platform where we want to acquire other closed blocks of runoff business, primarily annuity insurance blocks. And one of the methods that we would like to use to acquire those policies is insurer divisions, or Connecticut's version, corporate divisions. Like the IBT Model Act that NCOIL passed during the March meeting, insurer division statutes address the significant limitations to the current methods available to insurers to transfer or assume blocks of insurance business in an effective and cost-effective manner that provides needed legal finality. As the department spoke prior, both IBTs and divisions are restructuring mechanisms, but they go through different processes as to how a insurer can transfer or assume the different policies. With insurer division models, it's it's an entity level transaction that's like a reverse merger that must be approved by the state insurance regulator after a rigorous review process, a public hearing, and a notice. The U.S. insurance regulatory framework offers limited options to provide the legal and economic finality of insurance risks when an insurer changes its business strategy or decides to internally reorganize, completely exit, or acquire new businesses. Divisions provides that legal and economic finality to insurers and allows for more efficient allocation of capital, which can benefit policyholders. More efficient allocation of capital can lead to better product pricing. Policyholders also benefit when insurance businesses are aligned with an insurer's current business strategy and are the core focus of management, shareholders, and regulators. Rather than being a distraction for an insurer who is focused on different lines of business, under the current business strategy, insurer divisions or policyholders can benefit when companies focus on that core business. The need for the legal and economic finality is reflected in the wave of corporate division acts that have been enacted or actively considered across the country. As was previously mentioned, 5 states currently have insurer-specific division models, including Connecticut, Illinois, Michigan, Iowa, and Georgia. A bill was introduced in Colorado and was being considered in the previous legislative session. It did not go to the floor for a vote, but we do expect that bill would be reintroduced in the next session. There's also division laws in Arizona and Pennsylvania, which apply to all industry. Delaware authorizes a division of limited liability companies, and Texas allows for a provision in its merger statute to allow a divisive merger, which is a single organization where a single organization, including an insurer, can merge with the same effect of the division. So we're thrilled that NCOIL is considering adopting an insurer division statute. Just like IBT, we need more mechanisms in order to keep the insurance division, or sorry, the insurance regulatory system modernizing.
All right, thank you. All right, Karen, I think do we have any questions from somebody in the room? Will, did I hear something?
No, Mr. Chairman.
All right, thanks. All right, I think it's time for Karen Melcher, then Ernie.
I closed the door, so hopefully Ernie won't knock on it and want to be let in. So good morning, Mr. Chairman, fellow members of NCOIL. Thank you for this opportunity to speak. My name is Karen Melchert. I'm with the American Council of Life Insurers. And this is not a subject that you haven't heard from me before on with respect to the IBT. But I come to you today, first of all, for thank you, Senator Lesser, for bringing forward this corporate division model. This is something that ACLI would like to see enacted by NCOIL, something we can support as a mechanism that can be introduced in other states that wish to enact corporate division laws. That being said, I'd just like to go through a couple of our principles that we evaluate these proposals by and point out that they are, I think, there is some more work to be done on the model that's currently before you. First and foremost, our focus on the evaluation of these proposals is the protection of the policyholder. And for that to happen, we believe that impacted stakeholders and policyholders must have access to the process. And that is one issue I think we spotted in our brief review of the model in its current form. The hearing is not required unless the dividing insurer requests it. And as Commissioner Belfi noted, access to this process and policyholder notification and a hearing would be something that we would seek to have as a requirement, not as a discretionary point in the model as written. Secondly, on policyholder notification, in the model before you, the notification plan may be required by the commissioner, but there's no independent or mandatory requirement, and we would suggest that policyholder notification be required in the model before you. Also, contrary to what Commissioner Balfi believes, in our principles, we do believe that an independent expert must be retained for protection of the policyholder. In our opinion, the more experts that look at a plan of division, the more likelihood it is to be viewed as good for the policyholders, good for the companies. And it's actually something that is paid for by the dividing insurer. So it is no cost to the insurance department. It is a cost of the transaction, but one we believe is worthwhile and should be included in the model going forward. The other issue that we raised is that there is mandatory approval of a division plan, which is similar to the language that you see in mergers, but it doesn't give the commissioner discretion to not approve a plan, even if it meets all of the requirements, all of the financial requirements and the protections. It doesn't give the commissioner the opportunity to say, you know what, I'm just not comfortable with this for whatever reason. And we know there are some transactions that some commissioners might not be wanting to approve for whatever reason. We think that there should be some discretion in that as well. And then finally, there's a couple other technical issues which we can get into with some suggested edits, but Bridget did reference the bill in Colorado, which was House Bill 1091. We were engaged in that bill in Colorado and were successful in drafting amendments with the proponent of the bill and working with the Department of Insurance. Those amendments were adopted by committee, but were not yet adopted on the floor. That's the way the process works in Colorado. Were it to be adopted, those amendments to be adopted into the legislation, that would be something that we would be okay with, be supportive of. So we would suggest maybe taking a look at the final form of the Colorado model. It was based, from what we were told, on the Illinois model, the Illinois law, which was actually based on the Connecticut law. So there's kind of been these iterations as they've gone along with added improvements, taking a second look, what else do we need to add into that? One of which being the guarantee association coverage. We do think that language needs to be a little bit stronger, or at least a little more fleshed out so it's clearer how that works. And we look forward to working with all of you on crafting a model that we can stand up and support, and also turn to when this is introduced in other states. We recognize this is an important mechanism for our insurance industry to have, to be nimble and reactionary to the times we have at hand. So our request would be that we work on this to get this right. We know we had some issues with the insurance business transfer model, and we being ACLI were not successful in translating our principles into statutory language. We've done that with the Colorado bill and look forward to using that experience here to perfect the model that we can all support. So I thank you for your time.
Thank you. All right, next up, I think we have Mr. Paul Martin. Is he available?
Chairman and members, Paul Martin, Reinsurance Association of America. Let's start with the most important thing. Later today, my alma mater, the University of Miami, nationally ranked, undefeated, takes on that school from Tallahassee. And I know all my NCOIL friends join me in wishing well and wishing for the success for the Hurricanes to go 3-0 later today. That's the most important thing we need to discuss. Since today is game day, I thought I would couch my comments in keys to victory to a successful division bill. And from RAA's perspective, there are 4. The first is notice of an opportunity to be heard for all parties, not just the dividing parties, but also the policyholders and the reinsurers. That's the first key to victory. The second is confidentiality of sensitive financial information. As you can imagine, in the middle of a transfer, in the middle of a division, there's lots of information. Some of it is fairly sensitive. We want to make sure there are protections in the bill, in the model, that are there to protect that information. The third key to victory is respect for contractual rights of parties. And a division inherently involves an involuntary substitution of a party, to which some parties to the contract don't necessarily have a say unless there's opportunities to be heard. So we want to make sure that contractual rights are respected in whatever the bill looks like in its final form. And lastly, the director touched on this, and we agree, the fourth key to victory is transparency of the proposed division plan. Everybody needs to know what's happening in the plan so that it's transparent, so there are no questions down the road. Now, with regards to the plan, the bill, the draft as written, there are some concerns, and I'd like to talk about those. Assemblyman Cooley talked about, in regards to the guarantee bill, defined terms. And we think that's important, and we think there needs to be more defined terms in the model bill than there is now. We'd like to see beefed up adequate notice to all parties, not just the reinsurers, but to policyholders as well. We'd like to see a reasonable description of all the assets and liabilities that are going to be divided. We think we can work and provide some language for that. We do have some concerns about the asymmetrical treatment of creditors on one hand and policyholders, annuity holders, and reinsurers on the other. We'd like to address that. And finally, we'd like to see sufficient authority for the department to completely review this and then approve or disapprove. We'd like for the commissioner, the director of all these states that would be signing off on these, to have the adequate authority to do that. Now, more good news. First piece of good news, Miami's 2-0 and nationally ranked. Second piece of good news is that, as Karen mentioned, we do have an outstanding guide, House Bill 1091 from Colorado, the amended version this year. And by the way, Karen was way too modest in describing the work that ACLI has done. Tyler Laughlin, a name known to many of us, formerly of the Oklahoma Department, is having an outstanding rookie year at ACLI. He did a lot of leadership work in getting this bill, the Colorado bill, the amendments in the bill. It is an agreed to bill. All the stakeholders are happy with it. All we have to do is to look to that amended Colorado bill and use that as our lodestar moving forward. And I think we can get this division bill to where we need to be. Thank you for your time, and we look forward to working with all of you moving forward. Go Miami.
Thank you, Paul. And well, you're right. Everybody's excited about football season. I will tell you, that team from Tallahassee took two very good running backs from us here. Warwick Dunn, one you probably heard of, and Travis Minor, both from Catholic High in Baton Rouge, the same school that Clyde Edwards-Hilaire went to, so and attended. So I'm with the Canes on this one, so I'm with you. All right, Bob Ridgway, you're up.
Thank you, Representative Jordan. I am Bob Ridgway with America's Health Insurance Plans. I could pretty quickly get to the chase on this and say that I could echo most of the remarks that Karen Melchert made, as well as those made by Mr. Martin moments ago, excluding those about football. I'm going to leave that alone. But the main points that we are very concerned about are as follows, and these have been touched on. But in 6.1, as I read this proposal, it could be done. A transaction could be completed and approved without shareholder approval, which I really don't understand. Section 7A has provisions that I read to say that the transaction could be approved without any hearing. Also in Section 7A, I see language that appears to me to read that it does not require policyholder consent in some circumstances, and in some circumstances may not even require notice to policyholders. These are points we've all already heard. But I think the bottom line is that this is all reflected mainly in Section 11F1, where the policyholder's rights are probably going to be applicable only to the resulting insurer. And most of us, just as a practical matter, we know that when consumers pick an insurance policy, regardless what it's for, health insurance, car insurance, homeowners, anything, life insurance, we usually pick a particular insurer for a reason. And oftentimes it's because of either the company's reputation or we have knowledge of their financial standing and how strong they are. If we change the policyholder's contract without his consent and perhaps not even with notice to him, if we change that policyholder contract, that's not what the policyholder bargained for. So long story short, my confidence is somewhat inspired because I know that Kathy Belfie has looked at this, and I know Ms. Belfie personally from business dealings and by reputation. And that makes me feel a lot better. I also see some provisions about preserving guarantee fund coverage. That preserves, that helps me feel a little better about this. However, I also remember that guarantee fund coverage does not always make all policyholders whole. Sometimes they are left with only partial relief, not always, but sometimes. So there are a number of problems here with this bill that makes me particularly skeptical. And most of my friends let me rephrase that. The few of my friends that I have talked with in the guarantee fund world have concerns about this bill in particular and bills of this nature generally for many of the same reasons that I've set out. Having said all that, I look forward to working with Senator Lesser to see if we can tighten some of these provisions up. I suspect I'll also be talking with Karen and Karen, both Karens in this, to try to find a way through so as Karen Melchert mentioned, so that we can all support this proposal and turn it into a model. Thanks. I'll be happy to answer any questions.
Thank you. All right. Do we have any other legislative comments or questions? Anybody in the room? How about any closing comments from you, Senator Lesser?
Yes, Mr. Chairman, that requires me to find the mute button though. So, no, I want to thank you for allowing this discussion to go forward, and I appreciate all of the comments that we've heard this morning, and we'll be circling back on that before proceeding forward. So I really appreciate it, and I think this is an important conversation, and I appreciate the feedback from various stakeholders with ways and ideas about how to make the bill better.
All right. Well, hopefully we'll continue the conversation and move forward toward a bill that is acceptable to everybody. And we go from there. Danny, did you have something?
Yeah, thank you, Mr. Chairman. I just wanted to make sure you were taking any other interested party comments.
Yeah, you can go ahead.
Thank you very much. My name is Danny Llewellyn, an attorney with the law firm of Figure, Drinker, Biddle, and Reith. I'm here virtually on behalf of the National Organization of Life and Health Insurance Guarantee Associations, or NOLGA, and the National Conference of Insurance Guarantee Funds, or NCIGF, the two national coordinating bodies of the state guarantee system. Both organizations want to ensure that the Insurer Division Model Act will achieve what everyone agrees is a key objective to preserving guarantee association or guarantee fund coverage for all affected policyholders following an insurer division. NOLGA and NCIGF are reviewing the model, and they expect to submit comments regarding that point in the future. Appreciate Assemblyman Cooley's comments from earlier, and Karen and Bob, your words as well on this key objective. Mr. Chairman, I appreciate you keeping the floor open and look forward to discussions on the model in the future.
No problem. Thank you. We have any other questions or comments before we close? I think we're good. Well, thank you guys for that. Do we have any other business that we need to discuss? All right, I'll hear a motion for adjournment then.
I move we adjourn, Mr. Chair.
Second.
Somebody will come off mute.
Second.
Thank you, Mr. Chairman. All right, well, thank you. All in favor?
Aye.
Aye. Any opposed? Well, I thank you, and I look forward to seeing all of you in person in Tampa. So thank you again.
Thank you, Representative Jordan.
All right.
Thank you.
Very well. All right, we will call this meeting to order. It's the meeting of the Life Insurance and Financial Planning Committee. Welcome all, both virtually and in person. The first item we have to do is the Zoom member roll call. So if there's any members, legislative members on the Zoom, please identify yourselves.
Assemblyman Ken Cooley, California. Good morning.
Any other members?
Peggy Mayfield from Indiana.
Welcome, Peggy. Right, hearing no others, our next item is I would entertain a motion to waive the quorum. Motion
Second.
and a second to waive the quorum. All in favor?
Aye.
All opposed? Waiver is adopted. Next, we would entertain a motion to adopt the minutes of the March 6, 2020 committee meeting. Is there a motion? A motion by Assemblywoman Pam Hunter. Second? There's a second. All in favor?
Aye.
All opposed? Motion is adopted. The first item, agenda item we have is a discussion about the COVID-19 and the insurance industry. This is not just a PNC issue. Joining us today is Quellen Ellengrud, leader of the life and annuities practice in North America, senior partner for McKinsey & Company. Quellen, are you on the call? She's not.
Maybe need to unmute.
Think you may have to unmute yourself, perhaps?
Mr. Chair, I thought we were going out of order now to allow him more time to join, and we were going to go with the life settlements.
Oh, okay. I thought she was ready, though. Well, we will wait on that one. We will proceed with our second agenda item, which is the presentation of life insurance settlements. Wes Bissett, Life Insurance Settlements Association representative, and Michael Freeman, CEO of Lighthouse Life Solutions. Welcome, gentlemen, and please proceed.
Thank you, Mr. Chairman. Good morning, everyone. I am Wes Bissett. I had the opportunity to speak before you yesterday on behalf of the Independent Insurance Agents and Brokers of America. I'm happy to be here this morning on behalf of another industry association, the Life Insurance Settlement Association. Life settlements provide life insurance policy owners with a way to sell their policies that are no longer needed or wanted and at a value that typically far exceeds what they would receive for cash surrender. Settlements essentially are a way to unlock the market value that exists in a life policy and provide an alternative to lapse and surrender. LISA, the Life Insurance Settlement Association, represents that market and has been in existence now for about 25 years. When it was established in the early to mid 90s, settlements were still somewhat of a new concept, and regulation of that market was inconsistent. Much has changed in the last quarter century. The industry has matured significantly, and we now have a comprehensive regulatory framework in place, and a lot of credit for that goes to NCOIL. NCOIL first adopted a life settlement regulatory model in 2000, updated it in 2004 and 2007, and many of the state laws that exist today are based on that model or a very similar NEIC proposal. Our goal today is really educational. I know a lot of people will come to meetings and say, we don't have an ask for you. This is one of those rare times when we really don't have an ask for you. We just plan to walk through a little bit what settlements are, what the market looks like in 2020, and how life settlements can potentially help seniors and provide much needed resources for seniors dealing with retirement, long-term care, healthcare needs, et cetera. I'm going to leave the heavy lifting to my colleague to my right, Michael Friedman. Some longtime legislators may remember Michael from his days at Coventry, the largest life settlement provider in the market. He was there a dozen years and worked extensively on legislation across the country. He's now the CEO and co-founder of Lighthouse Life Solutions, a life settlement company that operates outside of Philadelphia. So he's now on the business side. He's moved up. He's a big shot now. He's also an active LISA member and chairs the association's Public Policy Council. So I'll be quiet and turn things over to you.
Can you turn on your mic, please?
Sorry, I planned on doing that and then I forgot. But it's a good opportunity for us to be here for those who have been around the issue of life settlements from a legislative and regulatory standpoint, or for those who are new to the issue. This is a good opportunity for us to share with you what's gone on in the last number of years and what the state of the market is today, and why it's particularly relevant and timely, considering what's, the aging of America and the healthcare crises that we face. So we have a presentation that I'm just going to walk us through and really would invite any questions as we go along. It begins with what is a life settlement, and quite frankly, a life settlement is just this, is simply the sale of an in-force life insurance policy. When that policy is sold, the policy owner receives, in many instances, a cash payment, can also receive something called a retained death benefit option, or some combination of the two. Most policies are universal life, but it can be for whole life and term life, and under certain circumstances, guaranteed universal life and other types of life insurance. People who sell their policies receive, as a matter of law, greater than they would get if they surrendered that policy and the policy had a cash surrender value. It has to exceed that, or accelerated death benefits that might be available under the policy. But as a matter of practice, the average life settlement pays multiples more, 4 times more, 10 times more. It's a factor of the age and the health of the insured. It's a factor also of the policy itself. So there's a lot of reasons that they vary, but the average based on national studies is greater than 4 times more than surrendering the policy. And as a practical matter, when somebody lapses their policy, you get nothing. So it's infinitely greater to sell your policy if you're facing a lapse, and there's a value for it. The market, as Wes started to point out, is regulated by both having life settlement providers, which are the buyers of policies, be licensed by state, under state laws and by state insurance departments, as well as the intermediary life settlement broker who represents the policy owner. And we'll get a little bit more into that later in the presentation. And really, just as part of the introduction or reintroduction for some of you about life settlements, the root of the sale of a life insurance policy is in the fact that a life insurance policy is a form of property that the Supreme Court recognized many years ago, over 100 years ago, that it should have the same characteristics as ordinary property, ordinary quote unquote property. And really, the Supreme Court of the United States said if you limited who could buy a policy, an asset that you own, and limited only to certain people, and this court was referring to people with an insurable interest, then it would be worth less. If you could sell your house only back to the developer, if your car could only be sold back to the car dealership, and there was only one buyer in the market, it would be worth less, said the Supreme Court of the United States. So everyone who owns a life insurance policy owns a piece of property that is as valuable an asset that they may own. By way of example, this is just an illustrative example of a $500,000 life insurance policy that, as I pointed out, if you lapse that $500,000 policy, you just walk away from it, stop paying premiums, no action needed. There's no return back to the policy owner of any value. You get nothing. But if the termination is through a surrender and it's a policy, a universal or whole life policy with a cash surrender value, that surrender value is usually low. While it might have grown in prior years, by the time somebody is faced with whether to keep that policy or not, the premiums exceed whatever cash values in the policy And oftentimes that's the reason for surrendering the policy for whatever is left in the cash surrender value. But as I pointed out, a life settlement is demonstrably a more valuable option for somebody who isn't going to keep their life insurance policy. They're faced with a lapse or surrender, and they'll get on average 4 times more. In this case, an example of $500,000 policy, and just assuming, a fraction of that, $45,000, when they would have gotten $7,500 if they surrendered it, and 0 if they did nothing. And just as another brief example, people who are already in need of long-term care, people who are facing the need for long-term care or have entered long-term care, their ability to maintain a life insurance policy is challenged both by Medicaid eligibility, which is the reality for most people who receive long-term care, having Medicaid pay for that, but other financial constraints make it hard. So people who are in long-term care or at the doorstep are often getting rid of their life insurance policies. Well, again, selling that policy can generate real resources for somebody who can dedicate those resources toward their long-term care. And this is just a small example of a very average policy of $250,000. Somebody who needed long-term care was able to sell their policy for $75,000. Now, that's not going to change their life, but it's money that goes towards their care that can help them get into the proper level and type of long-term care, whether it's nursing home care or home care, assisted living, or skilled nursing. So it's a very good to be able to liquidate an asset, use that money, rather than have to rely on government benefits all the time. And the reality is also that very, very few policies ever pay a death benefit. Based on data from the insurance industry, in 2018, there was $57 billion in death benefits paid on individual life policies, but more than $700 billion worth of policies lapsed or surrendered in 2018. So 92.5% of the time, or at least 92.5% of all death benefits that were terminated in 2018 were terminated without paying the policy owner anything. And only in the case of death, or nothing or very little in the case of cash surrender. But more than 9 times out of 10, you're going to outlive your life insurance policy. And what we do know is that based on research data that seniors who have policies are more likely than the average policy owner to lapse or surrender their policy. And that's at a rate of about 75% of term policies owned by seniors that are lapsed or surrendered. They're just not, you just can't afford it, can't keep the policy. And the reasons are, as I pointed out, the need for care, for health care, and specifically long-term care, or really just cost of living in retirement. Most Americans don't have enough savings. Most retired Americans or near retirees don't have savings to cover their entire retirement, and they do manage their assets by liquidating them, by selling the home and using the equity. And then a life insurance policy is also capable to be sold and be used in that same way. Just a quick overview of the current state of the market. It's important to start with the available or the in-force life insurance market. And as you can see here, there's roughly more than $12 trillion of in-force life insurance in the United States today, of individual life insurance policies. As I pointed out, according to the life company data, about 700 billion lapses, or 750 billion, $750 billion lapses on an annual basis. But in terms of life settlement activity, with that as a backdrop, where there's 138 million policies and over $12 trillion of in-force life insurance, in 2019, life settlement activity was such that there was only 2,800 life settlements done in the whole United States in 2019, representing about $4.4 billion in death benefits. So this idea that the life settlement market's a threat to the life insurance industry or to anything, really, as a matter of calculating those numbers, it's a fraction of a fraction of a fraction of in-force policies that are being transacted today. The market is trending upward, primarily because there is a greater focus on smaller face life insurance policies. There's more direct to consumer marketing that's taking place in the life settlement market, where people who are in need of resources in retirement are searching the internet, or being also served ads in social media, Facebook and Instagram and other places. But the market is still very much a deep end market. As you can see from the 2019 numbers that are posted, the average transaction for a life settlement, that $4 billion in death benefits and 3,000 transactions or 2,800 transactions, represents merely, or an average of $1.47 million per transaction. Those are people that have $1.5 million on average. So the market is still very much focused on large face policies because there's still a large number of intermediaries involved, insurance agents, financial advisors, versus those people who are on their own looking on the internet saying, hey, I don't have an agent anymore. I don't have a financial advisor. What am I going to do with this life insurance policy? So the market is starting to change, but it's still very much in the large face market. As Wes pointed out, there's a great deal of regulation in this market as opposed to maybe 15, 20 years ago. 43 of the 50 states have laws on the books regulating the transaction. As I pointed out, the regulation includes licensing of providers and brokers. Interestingly and importantly, a life insurance agent can be a settlement broker by notifying the state in which they're licensed and they're transacting, if they have reciprocity of that license, that they're transacting as a broker. And by doing so, what is imposed on them is a fiduciary duty to represent the policy owner in the sale of that policy. They don't represent the buyer. They don't represent the insurance company. They represent the policy owner. And that's very unique under insurance laws and regulations, particularly life insurance. There are numerous disclosure requirements throughout the transaction that at the outset tell the policy owner about risks of selling their policy more generally and alternatives to selling their policy. And then as the transaction goes on, there's requirements that we advise the policy owner of how much they would get if they surrendered the policy, how much they would get for an accelerated death benefit, all sorts of disclosures. The compensation has to be disclosed if there's an intermediary involved. So the level of disclosure in this transaction and the level of consumer protections and life settlements overall has really made this one of the hallmarks of insurance and financial services regulation. The results are that according to the NAIC's own data going back 5 years, there's been 1 or 2 transactions that have been reported as a problem, or 1 or 2 consumer complaints filed with state insurance department over a 5-year period. So granted, we're a small number of transactions, but this is a senior financial service that doesn't have elements of allegations of fraud or reports and complaints. And as a matter of fact, to Wes's point again about having gone through an effort to regulate this market, today, as of now, there's virtually no legislation pending in the United States for life settlements, which is why we have no ask, is that the fact is that it's a well-regulated transactions. Consumers are getting the value for their life insurance policies, and they're doing so with greater transparency and accountability than you find in any other insurance or financial service transaction. That's regulation that NCOIL led the way on. I think it's important. And a number of states, from this map, you can see the overall state of regulation, but a number of states adopted either the NCOIL life insurance consumer disclosure model or some variation of it. Those are on the map where the letter D is. There's disclosure requirements that when somebody is giving up their life insurance policy, in addition to what they can do with once they give up the policy, there's the Disclosure Model Act says you have to tell them that there's options that allow them to keep the policy if they can find a way to do it, or if they're not, then they can sell it, or they can choose an accelerated death benefit. So NCOIL went even further in establishing strong consumer protection by having this Disclosure Model Act that was picked up and has been adopted by several states. And most importantly is the individual life insurance policy owner. Somebody who sells their policy does so for a variety of reasons, as I mentioned, most often because they need the money in retirement, either for healthcare or just cost of living in retirement and other things. But what we find from an industry-led study or a company-led study within our industry that most people use their proceeds for their long-term care and their health care, whether it's buying long-term care insurance or a hybrid policy now, or to pay for direct care, health care, particularly long-term care. Some use it just to supplement their income in retirement because they're liquidating this asset and using the money for that. And I think it's obviously very much needed in a time when there is a retirement crisis. You know, the silver tsunami, as we've, I shouldn't talk, but we now have the baby boomers turning age 75. The oldest baby boomers are now at that age, and we know that there's a need for resources in retirement for seniors. We know specifically that there's a healthcare crisis for seniors, that a majority of seniors are defaulting for long-term care onto Medicaid to pay for that long-term care, and that the costs of nursing home care and other costs of healthcare are rising. And the out-of-pocket expenses that are not covered by either Medicaid or Medicare for people can be very, very expensive, as much as $500,000 out of pocket for a couple starting at age 65. So it's really quite dramatic, and the need for those resources. And here's an asset, a life insurance policy that 9 times out of 10, they're going to get rid of for little or nothing in the form of a lapse or surrender. But that policy, that life insurance policy in a folder in the drawer, can have as much value as the equity in their own home. So the ability for them to know about life settlements, their ability to sell that policy and use those monies for whatever they need it for, is as if you were selling any other asset you owned. And that's what's going all the way back to the Supreme Court. In 2017, the National Association of Insurance Commissioners, looking at innovative ways to finance long-term care, included life settlements as one way for seniors to help finance their long-term care needs, and reported, along with other options, that not only the value that policy owners can receive by getting 4 or more times the cash surrender value, but also among all of the options that were innovative in the NAIC report, the life settlement option was the only one that a senior didn't have to shell out any money in order to benefit, to have money for long-term care. It wasn't the purchase of an LTCI policy. It wasn't the purchase of a life policy with long-term care benefits. It wasn't anything other than selling that policy, which didn't cost them a penny and only made them some money. So it was a good to be included in that as among recommendations that can help seniors pay for their long-term care. And as we are here now, as the Congress is winding down, there's a bill in Congress that would allow seniors to sell their life insurance policies and take the proceeds from the sale tax-free if they were to roll those proceeds into what's called a senior health planning account. That would be similar to a health savings account or other FSAs, where you can defer taxes paid by dedicating the money into that account. As long as they're used for qualified medical expenses, then the proceeds and the roll that are rolled over into that account would remain tax-free. And if you think about it, every other American is incentivized, every other age category of seniors, of Americans, is incentivized to invest in healthcare through HSAs, FSAs, and others, except seniors, who are the most expensive, costly group by age of healthcare recipients in this country. So they don't have any way to invest or to save for or plan for and pay for their costs of healthcare in a way that all other Americans can. So this is a proposal that has bipartisan support in Congress. It obviously needs to get further vetted, but it's an idea that is consistent with existing public policy at the federal level that allows for people who are dying, who have terminal illness or chronic illness, to sell their policies tax-free. This is for people who don't have to be at that stage of life where they're diagnosed terminally ill or chronically ill, but who can sell their policy, but dedicate those resources for long-term care and get the tax-free benefits of that transaction. So it's very consistent with existing public policy. But that's a sign that this market is becoming more and more accepted by public policymakers. NCOIL has led the way in this effort to put regulation on and give this market the structure it needed, 15, 20 years ago, to the point where now there's potential tax advantages or tax benefits that are being that would benefit policy owners that are being considered in Congress on a bipartisan basis. So it's a long journey, but that gives you the sort of the current state of the market, a little bit of the history and the state of regulation. And I appreciate the opportunity to speak before you, and certainly am open to any questions. And Wes is too.
Thank you, Ms. Friedman. Appreciate the presentation. Senator Hackett has a question for you.
Yeah, thank you, and I appreciate the work you guys done in cleaning the act up. And I saw where there was only a couple complaints, but you and I will know, going back 15 to 20 years ago, we had hundreds of complaints, and we needed the regulations to step in because it was almost like the wild, wild west. And people had to realize is that the brokers were in between the people buying the policies and the insured selling the policies, and the commissions made were unreal. I mean, just unbelievably high. And there's a principle of follow the money. There has to be money there. So we used to say either the insured was going to get screwed or the investor was going to get screwed until we got regulation in there. One question I'm surprised you don't hit more is one of the problems we're having in life insurance, we have had for the last 20 years, and I'm not criticizing universal life, but when a lot of universal life was sold many years ago, interest rates were so much higher. And these policies are really going to blow up, much, much, much early. Are you staying away from those policies because you just think they're too expensive to keep in force? I mean, what's the issue? Because I don't see as an area of where you would market to, because there's there's billions of dollars out there where these policies are going to blow up. And the problem with that, you and I know, is that either TEF or the IRS guidelines is you can't really lower the death benefit too much in these policies. They keep you from allowing to do that. And that makes, I wish they changed the law on that, because some people want to have something there when they die. So why are you not talking more about that problem?
Well, thank you very much for the question. And it's an interesting question because everything you just described is why people are dropping their universal life insurance policies at a high rate, especially at the older ages when the premiums are doubling every year and the cash value is being depleted. So everything you're describing about those policies, that the value, the cash surrender value or the account value didn't get to where it was because interest rates have been at a historic low. That problem is a consumer problem. And it's also, from a life settlement standpoint, an investor in life settlements problem, because what carriers are doing to address this in many places is raising costs of insurance, which is within the rights of the policy. It's contractually provided for. But when those COI increases to offset the costs inside the policy to the insurance company are passed on to the policy owner, that's causing them to terminate their policies, but it also makes those policies less attractive to the life settlement market. So, but again, that is, done properly. Cost of insurance rate increases are protected and reflected in the policy itself. But it's a challenge. It's a challenge both for us being able to help policy owners get the value. If the life insurance company were to raise the premiums to recoup their costs over those years, but it does wind up hurting both, the consumer for not being able to keep their policy and also not being able to sell it.
Any other members have questions? If not, I want to thank the presenters today. Very enlightening presentation. Thank you.
Thank you very much.
Now our next item is the COVID-19 insurance industry, not just a PNC issue. Is NCOIL Ellengred available?
Yes.
Well, welcome. NCOIL is the leader of life and annuities practice in North America and senior partner for McKinsey & Company.
Wonderful. Great to be with you today. And I wanted to spend some time exploring the impact of COVID-19 on life insurers and what are some of the key trends that we've been seeing and hearing as we talk to life carriers across the country. If you flip to the first page, maybe just 4 main areas that we're going to focus on today. One, kind of at a highest level, what is the impact of COVID-19 on life insurance in terms of broad trends? And then I'll spend a bit of time going deeper into 3 main areas that I think are worth exploring in a bit of greater depth. The first is digital and analytics and trends that we're seeing there in the acceleration, particular areas of focus. The second is, in such a record low interest rate environment, product innovation and what we can learn from Japan, Germany, and elsewhere on capital light product innovation, which we're likely to see a lot more of in this market. And then the third is around in-force actions. We've seen some of these over the years, frankly, more as we look around the world, but I think we'll start to see much more of this in the United States, and a couple thoughts on the direction that some of that is taking. So if you flip to this next page, if you index all the way back to sort of the end of 2019 across all industries, I think it's worth noting that insurance in particular has been impacted from an equity markets perspective much more than many other industries. Now, if you look at this sort of darker, bolder red line, that is the World Insurance Index. Of course, on the downside, impacted more than insurance, you've got travel and logistics, right? Nobody's staying at hotels, nobody's flying on airplanes, or very few. You've got banking, which is equally hit by low interest rates and likely some of the small business and other failures in the market. And then you've got oil and gas, which had sort of a record drop in the price of oil globally. So those industries certainly have been hit harder than insurance. But insurance overall, if you look at this red line, has been hit harder than the overall world average in blue, and quite a bit harder than technology and pharma, which for clear reasons related to COVID have actually been doing reasonably well. On the next page, there are a number of very specific to insurance disruptions that we're seeing. Operational disruptions, of course, for our P&C and commercial colleagues on that side of things, questions around what is covered in business disruption, but closer to home in life insurance, challenges around, reduced appetite for higher value policies, certainly on the term life side and for older, covering older policyholders, for instance. The challenge of in-force blood draws and a highly paper-based new business and underwriting application process. We also have operational disruptions, right? As many hundreds and thousands of call center reps went home, a lot of those operational challenges became clear. And now I would say much more cyber risk exposure than we've had before, and a lot more exploration of that area. On the right side, there's also pricing, product, and balance sheet challenges that insurers have faced. So low interest rates at a level that most carriers have never seen, certainly not in the US. Our P&C cousins have seen a lot fewer miles driven, but certainly some back and forth in consumer pressure to give back some of those premiums. In the life insurance space, we're seeing a lot more pressure on in-force blocks and what to do with them as sources of value and sources of sort of revenue and funding are scarce. We'll talk a bit more about that. We also see broader balance sheet challenges as we see a bit more on the credit migration side and a risk of broader instability in the financial markets linked to some of the variable annuity risk, which we've seen over the years, but is certainly present here as well. So lots of both operational, pricing, and product challenges that we see. In responding to those challenges, I think there's 7 broad trends here that we have seen insurers really react to or accelerate as they try to address some of those challenges. The first 3, as I mentioned, we're going to spend a bit more time together on and dig into a bit more in depth: digital and analytics, innovation in the product portfolio, and in-force, and making that a strategic priority. I'll just touch on some of the others briefly before we jump into those 3 in more depth though. Getting serious on cost. Life insurance carriers, compared to many other industries like telecom, like consumer and others, have not really improved their cost structure much. And when they do, it often doesn't stick. And what I'm seeing across the industry is a much stronger focus on improving expense ratios overall and trying to make some of that stick, not necessarily to take it out and keep the cost structure low forever, but to invest in digital efforts, analytics efforts, fund some of the growth initiatives that they're looking to have. In terms of exploiting a strength, I think a number of carriers are looking to M&A, not just within insurance. There's certainly a bit of a look at smaller carriers, maybe less capital comfortable carriers in terms of potential acquisitions at pretty attractive multiples. But there's also a look at fintechs, right? Fintechs where they might have been partnering before, but now some of those fintechs are struggling and not able, both on the revenue side as well as on the funding side, to do as well. There's some opportunistic looks in the M&A space as well. Upgrading talent and shifting ways of working. Some of this, frankly, is inevitable, right? As almost all insurance carriers, I would say 90% plus of employees have gone home and are working remotely. This is a window of opportunity for carriers to rethink their operating model and how they work. And so a real thought of, how do we want to work in the future? How will life claims be handled? How will new business and underwriting be handled as we move ahead? And how do we avoid shifting employees from one situation and then shifting them again as we figure out the end state? How do we look ahead to where the puck is going? Frankly, shape some of that strategically as well on where we want it to go. And then as in parallel, shift our ways of working, but also upgrade our talent as needed. And so we've seen a lot of smaller pilots, I would say, in terms of reskilling, for instance. Some carriers are taking, for example, call center reps and shifting them over time to do very simple entry-level IT training. We've seen also some finance and reporting folks be trained to do entry-level analytics, advanced analytics work. But most of those reskilling efforts are on a pretty small scale so far, and really making that at scale, more than a few dozen employees to the hundreds, is what we're starting to see carriers plan for as they shift to new ways of working. And finally, we have seen a pretty steady shift from a number of carriers shifting to more fee-based earnings. You've seen this in Ameriprise over the decades, but others as well. And we will likely see the continuation of this as capital-heavy products get less attractive in this interest rate environment, and fee-based earnings become a bit more attractive, certainly from a valuation, an equity markets valuation perspective, but more broadly to balance the portfolio. So those are the trends we're seeing accelerate overall, but would love to jump into this first one on digital and analytics. Three broad shifts within digital and analytics. First, I would say all life insurance executives that I have spoken to have noted the really rapid acceleration of digital and analytics. Some of them have opted into that and really welcomed it in terms of more straight through processing, more online and automated underwriting. And others have felt like they've had to jump into it for lack of any alternatives. But by and large, I would say the general consensus is that whether you call it 5 or more or 4 to 6, something in that range, but 5 or more years of progress has been made in the last 6 months since COVID started. And some of that is because policyholders who might not have opted into self-serve capabilities before, would have rather met with their agent in person, are now forced into new channels. And so some of that is consumer and policyholder driven, some of that's agent driven, some of that's just the environment. But carriers have been able to take advantage of that to further accelerate some of those shifts when they've wanted. So the accelerated shift to digital is certainly one of them. In that context, we've seen a lot more analytics as well, advanced analytics to identify leads, to better match those leads with agents, to do better underwriting, accelerated underwriting with less data, for example. And then to support that, we've also seen a shift in technology to more microservices in the cloud, for example, more efficient technology use overall. A little bit of detail on each of these three as we shift to the next page. We did a survey over the last couple months with over 600 different agents in the United States, and we asked them a number of questions. On the left, we said, what's been the biggest challenge for you working with customers in the COVID-19 pandemic? Over half of them ranked building initial client relationships remotely as their number one. Number two, with 1 in 5 choosing it as the first, was generating leads. So very much the same thing. Almost all of them said finding new business, finding new leads and new customers. In the middle column, we asked, what portion of time do you spend on each of these activities in a given week, in average week. And we compared sort of the pre-COVID survey responses with the post-COVID survey responses. And by and large, it's about equal, with the pretty glaring exception of customer-facing sales time. About 26% of the time before COVID was spent with customers, only about 16% of the time after. And you can imagine that's a much more digital engagement model, right? So some agents are piloting, how do you do a dinner conference call with a couple to talk through their planning situation, their life insurance needs. Some of them are really liking that, right? They don't have to pay for dinner anymore. It's easier to kind of get their undivided attention. And so some are actually finding some of this lead generation experience easier, but I would say the vast majority of agents are finding it quite a bit harder. And on the right side, as we ask agents, what are you looking for your carriers, whether they're captive or independent, to help you with? About 1 in 3 said, I need them to really provide more lead generation support. And about 1 in 5 said, I need more digital tools and more self-service capabilities. So a real acceleration in e-signatures, right, DocuSign and others, as well as better data to underwrite without in-person blood draws. On the next page is analytics. And we did a broad survey of over 1,000 companies with over $1 billion in revenue or premium, and looked at those that had really captured true at-scale value from analytics. I think every company these days is doing analytics in some pocket of the organization, but only about 1 in 10 companies are truly capturing full at-scale value from analytics. And we said, let's look at what those 1 in 10 companies are doing disproportionately and differently than other companies. And on this page, you've got what those companies are doing differently. They're twice as likely to use agile teams and cross-functional collaboration. They're 2.5 times more likely to have clear decision-making rights and accountabilities. 1.5 times more likely to actually refine that as they put that in place more explicitly. 2.5 times more likely to invest deeply in analytics talent, especially in this analytics translator role that can take a business problem and the analytics science behind that and translate the two to speak the same language on both sides and connect those dots. And finally, they're 4 times more likely to devote more analytics resources and dollars to last mile conversion. What we often find is that companies are creating really effective models, especially with machine learning and other advanced analytics capabilities these days. The real difference in those who capture significant value is that last mile translation. How are you making that black box of analytics insights transparent and clear to the agent so that they can act on the next best conversation to have or the next best need to fill, for example. It's that last mile translation that's really been the gap. So that's on analytics. And then on the last page, in terms of IT backbone and making IT spend both more flexible and more efficient, we're seeing a number of trends here. Again, some of the same trends you'll see in dynamic, transparent, but also cross-functional structure. More agile teams, a really strong backbone with cloud and sort of agile apps there, and then a very clear roadmap. And this roadmap applies to IT, it applies equally to agile, it applies to analytics, right? The companies that have, for example, a clear analytics roadmap on here's the use cases that are going to drive the most business value, but also here is where replicating those use cases for a different part of the business is going to give us additional impact. Those roadmaps are much more effective than a bit of the bottom up, right? 1,000 flowers bloom. Let's let each different business unit innovate in its own way. So a bit more of this centrally planned with an eye to replication and sort of strategic application of some of those use cases across other areas. So that in a nutshell is the first trend on digital and analytics. The second area we think is really going to accelerate, especially in the US with these low interest rates, is product innovation. A few trends overall that we've seen. We have seen carriers, even if you ignore for a moment the low interest rate environment, in periods of high market volatility, there is much more market share gain and loss across the industry than typical. So even in a normal interest rate environment, we would expect a lot more market share shifts right now and over the next couple of years than typical. You add to that a very low interest rate environment, and carriers are going to be looking hard under every single rock for potential sources of value. As we look globally at examples, right, Japan has had a low interest rate for decades, Germany even for over a decade. They are innovating with capital light products with fewer guarantees. And I think this is a trend we're going to see deeply in the US market as well. We do think that lessons in agile product development can apply there, though, in product innovation. And so here, we'll look briefly at Japan and Germany. What we've seen in Japan is a very interesting separation of value from the 10-year indexed line that you see in blue that keeps going down, down, down as low interest rates sort of lower, with the life insurance index. The light blue line there is the Japan Life Insurance Index. And they've been actually able to maintain, or in some cases grow, the value within life insurance despite lower and lower bond yields and lower interest rates. On the next page, you'll see the same thing in Germany or in Europe more broadly. The same sort of the 10-year index going down quite a bit, but the dark blue line up above, insurance carriers continuing to kind of capture value there. A lot of that is driven by Allianz in a particular case in Germany, but many of these are broader European trends as well. On the next page, product specific, what you see on the left, and this is in the German market in particular, over the course of 5 years, just from 2013 to 2018, a really rapid shift to capital light products. Unit linked products, they were hybrids with a different type of guarantees, not sort of the traditional guaranteed rate, but what we would call as a class capital efficient products, as well as a bit of growth in unit linked products. And you see proportionately the traditional products halving in terms of their overall market share. And on the right side, disability insurance in particular was growing at about 8% per year in the German market. And so Allianz has been a market leader in Germany for a long time, but they've been really innovating on product and capital light products there. And as we back up and look across carriers, this is going to be a real area of focus. 82% of senior leaders in insurance carriers said they believe that product development is a core competency that they need. A quarter of them don't really have a defined product development strategy. And 12% of them actually thought that they do have a process that delivered strong product innovation. So it's a critical need. It's a real gap more broadly. And oftentimes you'll see carriers lump in product repricing with real de novo innovation. And so it might take them 6 months, sometimes even 9 months to reprice a UL policy, while the real, how do I dig into underlying client needs and innovate in this new environment, is put into the same team. And unfortunately, oftentimes repricing of the UL policy will crowd out all the other activity to do full-scale de novo innovation. And that's the challenge that we're seeing in many of these product innovation teams. On the last piece, or the last trend that we wanted to discuss is in-force. And in-force blocks have been looked at for a while, partially as a potential source of a large reserve release. But we've seen in the US much less action than we have, for example, in the UK, where there's been a lot of migration of closed blocks. There's typically, on average, simpler policies in many other markets. But in the US, we actually haven't seen as much movement as we would have expected over the last 5 to 10 years on in-force management. There's a lot of reasons why, and we explore a few of them here. Nobody typically owns it as much as they own kind of the channel or the business and the growth side of things. And the cross-functional collaboration that's required to pull this off can be a bit challenging. There's a risk of backlash from customers. So while many of those are closed blocks where you're not actively selling those policies, if they feel like they're dealing with a different company, that could be a frustrating customer or policyholder experience. There's just a lot to sort through. It's highly technical, so doesn't tend to be the first place that people want to jump in. And terms and conditions are largely set right 50 years ago when you first sold those first policies on that block. So there are some real legal and other constraints that are important to keep in mind. But as we look at this, there are 3 broad buckets of levers that we've seen some cutting edge carriers use as they look at their in-force management. The first would be transactional levers. So do I want to change my reinsurance on this block? Do I want to sell this set of closed blocks completely? Are more of the transactional levers. Above and beyond the deal value that you might get on a transactional lever, we find that technical levers are an additional about 20% of value, and operational levers can actually be another 30 to 40% of that value. So technical levers would be things like capital and tax management, reinsurance optimization, hedging, better pricing, those kinds of things. And operational excellence levers would be expense optimization, understanding the full life cycle value of those customers, outsourcing in certain pockets, data-driven claims management, segmented customer service and claims models, and then optimizing commissions. And overall, we find that that collectively can add another 40 to 50% on the overall transaction lever, but lots of sources of value to look at. And typically you would do this block by block as you look across the in-force management blocks that you're looking to optimize. Maybe the last piece before I open it up to any questions on trends and what we've seen more broadly in terms of COVID. This is a bit of a map that some carriers have used in terms of where do they want to shift each block, right? On the x-axis, operationally, you've got kind of keep as is in the middle. If you want to insource more of the work and do it more yourself, maybe you were outsourcing key elements, you want to insource all of it altogether. On the other side, on the left side, more of an outsourced model. And then on the y-axis, your balance sheet exposure and sort of appetite from a balance sheet perspective. Keep it as is would be more of an operations light owner if you wanted to outsource some pieces. You could also increase your balance sheet exposure, be a bit more of a consolidation consortium, for example, or you could reduce it if you wanted to be either fully exit or insource and be more of a broad service provider. So different actions or movements there that you would do. And again, you wouldn't have to do this across the entire portfolio. You could choose block by block, depending on the runoff, the different kind of capital usage and profile of that block. You might choose a different square on this sort of 3x3 based on that. So those were the three big trends. I think we can stop displaying now, but would love to answer any questions you have on broad trends as a result of COVID-19 or any of those specifics that we were just describing.
Thank you, Quellen. Does any members have any questions for her? Senator Hackett.
Yeah, the gentleman that spoke before you talked about the in-force business of universal life and the ability now that some commissioners are allowing in states, you know, an increase in the cost of insurance. So, I mean, what do you say about that? You're an expert on that, on the in-force. You know, I'm not as big a critic of universal life because it gives a flexibility, it gives you, you know, an option in between term and whole life. So, but what do you say about the concept of insurance commissioners allowing books of business to increase the cost of the insurance? And I'm talking about that curve of insurance. You know, as you get older, of course it's going to go up, but they're allowing people to actually move the curve out to a higher cost. And years ago, they would rarely do that because people were living longer every year. So what do you say about that? About in-force business?
Yeah. You know, I would separate the in-force and oftentimes the closed blocks that are no longer being sold with how you are pricing new insurance and new business. And then I think across the new business continuum, there is term insurance on the one side and then permanent insurance of which universal life, whole life, and variable universal life are all different types of it. I would say if you want the most cost competitive coverage, term insurance is certainly the way to go. Many are actually selling that at under sort of losing money, I would say. Life insurance as a whole, though, I would say is not really making much money at all. In fact, it barely makes its cost of capital from year to year. And so I think if you step back from the industry, overall pricing is about as low as it can go on some of those products. Now on universal life, that might not be the case, but on other product categories, I would say term life, it's certainly a highly transparent and price competitive market.
But isn't that, the result?
Maybe less so as you get to more the permanent side and more complex products like universal life and certainly variable universal life.
But isn't that the result of these historically low interest rates? And many of these policies, and when they were sold years ago, that's actually, it's hard for the insurance company to make the guaranteed return that they have to pay out. So they are losing money on some of the book of business because the interest rates are so low. Isn't that the factor of low interest?
Absolutely. I think it's a real challenge, which is why, no, so the interest rates and especially as you look at life insurers, right, in contrast to property and casualty insurers, they are holding these books and these policies on their books for decades. And so they've got to make that guarantee over the long period of time. But if 10-year treasury are at record lows, you don't have the ability to do that. And so where do you look for return, and especially a lower risk return? It's a real challenge. And I think that's why many carriers now are looking to lower capital usage products, as we were just discussing on the product innovation side, and then looking to cut costs wherever they can, whether that's better managing their in-force books or selling their closed books or reducing their cost structure overall. But it is a really challenging time as you look ahead with low interest rates and a lot of these long duration commitments to policyholders.
Thank you, Quellen.
And
One
I
more
think
question.
interestingly, it's a challenging time in what was already a really challenging industry, right? So even if you rewind a couple of years, the long-term profitability over the cost of capital in life insurance was already about 1% over the cost of capital. Now you add to that really low interest rates and it's even more challenging. So I think it's a particularly tough time for life carriers.
Yes, Quellen, could you give us an example of the movement from capital inefficient products to capital efficient products?
Yes. A couple examples of, so capital heavy products are traditional life insurance products, right? With a guarantee where you've got to keep a lot of that capital to be able to pay out the death benefit whenever that might happen. So both term life, universal life, as we were discussing, whole life, all of those are capital heavy products. A capital light product would be some of the products, for example, in Japan, cancer insurance, very targeted insurance, pet insurance, right? There are other policies that are capital light. Also, there's been a broader shift to fee-based products. So more on the wealth and investment side, you start to see a lot of fee-based revenue there, and that you don't have to hold any capital against somebody's investment portfolio, right? So that is very, very capital light and very capital efficient on the other end of the spectrum. So that would be sort of the two ends of the spectrum, with life insurance and traditional guarantees on the one end, on the other end, more wealth and investment products, and somewhere in the middle, some of those capital lighter products like cancer insurance or pet insurance, some of those things.
Right, any other questions? If none, we thank you, Quellen, for your presentation, very enlightening today. Thank you for participating.
Thank you, pleasure.
Any other business for the committee? If none, I'll entertain a motion to adjourn. Motion, second, we are adjourned.
Good morning. We're going to call this Health Insurance and Long-Term Care Issues Committee to order. I'd like to ask if there's any legislators on Zoom to identify themselves for this session, please.
Yes, this is Deborah Ferguson from Arkansas. Can you hear me?
Yes, thank you.
Martin Carbaugh from Indiana.
Thank you.
Ken Cooley, California.
Thank you.
Peggy Mayfield, Indiana.
Thank you.
Madam Chair, Pam, this is Senator Jim Seward from New York, your neighbor.
All right. Good to see you.
Likewise.
Edmund Jordan, Louisiana.
Thank you, Edmund. Okay, hearing no one else. I'd like to have a motion to waive the quorum, please.
So moved.
Second. All in favor?
Aye.
Thank you. I would like a motion to adopt both sets of minutes, please.
So move. Second.
All in favor?
Aye.
Okay. We're going to go right into our agenda. Our first bit of business is the consideration of the NCOIL Short-Term Limited Duration Insurance Model Act. I'd like to get some comments from Representative Carbaugh, and then we will be voting on this. So Representative, you're up.
Thank you, Madam Chair. I'm sorry I can't be with you guys in person. I'll keep this very brief. I'd like to thank everyone that has worked on the model and greatly appreciate everyone's input in discussing this. We started discussing it back in July. I think we're ready to finally put it forward for a vote, so I appreciate that. You can view the model in your binders starting on page 258. I believe strongly in the short-term limited duration insurance plans and that they're products that can really help people. And the model is based on a bill that I sponsored in Indiana. And upon that bill being signed into law, many of insured people in Indiana have been helped by these plans, and many businesses have come into the state and insurance companies to provide more competition and therefore offering better prices and better products. As you'll note in this model, there's requirements for certain coverages, and what I've seen so far in the short time that this has existed in Indiana is that we've had plans offer those coverages and then some, even some more, because competition is driving that. So it's exciting here in the state of Indiana. But it is important to note that states are free to oversee, regulate, and even ban these short-term plans. That's why we included the section or the drafting note in section 2. And it states, states are not required to offer short-term limited duration insurance plans. For states that choose to offer such plans, this model is intended to serve as a framework that can be adjusted accordingly to meet each state's needs. That note's important because opinions do differ on these, the value of these plans. And some states have in the past and currently prohibit the sale of these plans. Obviously, I disagree with that. But each state needs to look at it for themselves. And I would hope that some of those states that have looked down on these plans in the past maybe look to this model legislation, look to what's happened to Indiana, and reconsider that position as well. We had a great Zoom meeting of this committee about a month ago, where we had a final discussion on the model. We had really good input. And so with that, I would hope there'd be a motion to pass it in second, and I'll turn it back over to you, Madam Chair.
Thank you. Before we make the motion, I'd like to see if there's any legislators that have any comments, questions for the representative before we vote. No? Okay. I'd like a motion from someone to accept this model.
So move.
Second?
Second.
All in favor?
Aye.
Aye.
Opposed? Assemblyman Cahill. Okay. Congratulations, Representative. We're going to move forward now to item number 3. We're going to discuss the Telemedicine Authorization and Reimbursement Model Act. Obviously, many of you know here today, whether in person or virtually, and we're most likely on the interim Zoom meeting this committee had about a month ago, during which this topic was introduced, and I indicated that the first draft of a model would be forthcoming, which is in your binder, page 265, and it's our good starting point. And it's a perfect opportunity for NCOIL to step in and provide guidance to states. The expansion of telemedicine has undoubtedly been one of the most significant issues industry and consumers have faced throughout the past several months. I know in New York, we had issues relative to obviously the in-person, the reimbursement for telemedicine, just issues of people having broadband and being able to even be on a telemedicine call with their provider. So it is clear that action is needed on the state levels to make sure that the proper legislative framework is in place such that the consumers are protected. We have a perfect forum for us lawmakers to debate this, what should or should not be in the model for states to consider adopting. I am proud to sponsor the model today and look forward to discussing and developing it throughout the next several months. Again, the model you see before you is a good starting point. It is indeed a first draft, and there's certainly much work for us to do. So I appreciate all of the comments that have already been submitted. You may have received some of those, and we're going to jump right into our conversation. Not in the binder, but our first speaker today is Dean Cameron, who's the insurance director from Idaho. Mr. Cameron, are you available for comment?
I am, Madam Chairman.
Please go ahead.
Thank you, Madam Chairman, and let me applaud NCOIL and your efforts to discuss this important issue. My state, like many other states and the federal government, moved to loosen restrictions and remove barriers for telemedicine during this pandemic. And I think that causes us all to evaluate and reconsider those barriers that were there in the past. I'll just tell you from my state, we went from an average of 200 telemedicine visits a month to over 28,000 telehealth visits in the month of April. And it has dramatically moved forward. We have 5 carriers here in our state, and we worked very closely with those 5 carriers to remove any barriers to allow them to expand networks and to have the discussion and be able to use any provider who was willing to use the telemedicine platform. And that's worked pretty successfully. All of our carriers, even though they weren't required to by law, did pay providers at parity or at the same rate as if they were visiting in person. I don't know whether that will stand that way for forever, but at least that's the way it is for the foreseeable future, as they are trying to benefit consumers and give consumers choices. We also seen where telemedicine actually very much helped those with mental illness or needed a mental health provider. It turned out to be, in some cases, a preferred methodology to receive treatment and have that discussion. I'll just share with you some data from what we've collected at the NEIC, and certainly are willing to work with NCOIL as we have these discussions moving forward. And I think there are some considerations at the federal level, whether to continue to relax some of those privacy concerns and other concerns with telemedicine. Nearly 45 of our states have taken action since March to expand telehealth. 25 states issued orders to state regulated insurers. 19 states publicized requests to insurers, and 10 states provided notice of relaxed enforcement. I would say that in my state, we certainly we're not big on issuing orders, but we did remove the barriers, as I said. And so I guess we would fall into the relaxed enforcement. We obviously wanted to make sure consumers were protected. We provided, many states provided state regulatory insurers with similar flexibilities in Medicare providers, including those related to other platforms and sites. In addition to the 10 states with pre-existing state laws on payment parity, about 11 states issued bulletins or emergency regulations on payment parity. Our state, again, we worked with our carriers to encourage, I guess you would say, payment parity during the pandemic. But we also recognize that that there is a potential unintended consequence of payment parity of carriers moving to more out-of-state providers in the event that they are forced to do payment parity. So our state has chosen not to get in the middle of those negotiated contracts between providers and the carriers. So I'll stop there. There's a number of other items, but I know you've got a lot of other good folks that are going to speak. So I'll stop there and be happy to answer any questions, Madam Chairman.
Thank you so very much for your comments. We're going to move to Ann Johnson, who is the CEO of American Telemedicine Association, and she's here with us today. Good morning. I think you need to turn on your microphone.
There we go.
Perfect. Thank you.
See, this is synchronous communication in telemedicine language, so it's a little difficult to master. So thank you, Madam Chairman. Thank you, everyone, for having us here today. I am delighted to talk to you for a few minutes about what we've seen in telehealth across the country and tell you a little bit about the ATA as well. The American Telemedicine Association is the longest standing organization focused exclusively on the expansion, dissemination, and adoption of telehealth. The vision of our organization is to ensure that Americans get care where and when they need it, that when they do, they know it's safe, effective, and appropriate, while enabling clinicians to do more good for more people. Our membership includes a very wide range of organizations, including delivery systems, payers, academic medical centers, pediatric facilities, and then a range of solution providers, including organizations like NCOIL and Teladoc Health, who many of you have heard about, as well as organizations like Zipnosis and Bright MD, both of whom were in the forefront of providing support to delivery systems as they scaled their response during the pandemic. We also include in our membership organizations like Babylon Health and Conversa that provide AI-driven solutions for consumers. We also have organizations like Row and Hims and Hers that provide lifestyle and direct-to-consumer asynchronous support. And then we have organizations like Livongo and Vivify who provide remote monitoring to many of the hospitals in your communities. And then we also include in our membership a number of organizations like Microsoft, Sony, Verizon, HP, Intel. These are organizations that are enabling telehealth and really believe in this idea that high water floats all boats. So I think that the idea of the growth of telehealth has not, I mean, I would be remiss if I did not acknowledge that many of the statistics that you've already seen in terms of the incredible growth of the number of telehealth visits. I would say that telehealth is very broadly defined in our lexicon. It includes synchronous communication like we're having now, where we can see each other and go back and forth in real time. It includes asynchronous communication, which is, it could be text-based or chat, and a delay in conveying or providing information. And then it also includes remote monitoring, which has been really a lifeline for many Americans during this pandemic. The amount of activity that took place, I think that we've all seen the graphs that came out of CMS and other agencies that showed an incredible surge leading up to week 15 of this year in early April. And then we're seeing a drop off. But what we've seen is that the decline in telehealth visits has not been as, it hasn't gone to the same levels as it was pre-pandemic. And so I think it's safe to say that we're really very committed to ensuring that telehealth remains in place as long as it provides a safe and affordable and effective option for Americans. The idea is that we want to also serve as your resource as you examine this legislation or this model legislation so that you know that we're here. We have a number of items on our website that I encourage you to look at, including terminology defining telehealth, terminology and language for states on medical practices, standardized terminology for states in terms of policy language on coverage and reimbursement. And all of these emanate from the policy principles that were driven by the ATA, informed by the ATA. And that, again, is very much consistent with our vision that people should get care where and when they need it. You will undoubtedly see that there has been a lot, and you've already touched on this in terms of some of the policies at the state level that, again, we're here to support your deliberations now and in the future. I would first point out that what has been relatively new to many of us is the growth of asynchronous communications in telehealth. And I think that it is important for us to remember that even if it's new to us, it doesn't mean it's unsafe. Asynchronous services are provided by companies who are committed to the good health and well-being of Americans, just like our doctors in their offices. The topics that you're going to be dealing with, I'm sure, are including reimbursement, which we address in our policies. And like the fine gentleman from Idaho, and I've had a chance to work with their task force on telehealth, it's very important that we really acknowledge that there is payment that needs to be made for these services. The other area that I think we'll see contended with is originating site, that there were a number of barriers that were in place previously as it relates to originating site. Those were relieved with the waivers. And we hope that, again, in this idea that with originating site, we are able to continue that going forward. The reason why is that it is very often the best way for people to get care. So to have someone drive 2 to 3 hours from their home to see a clinician, when in fact that service can be rendered virtually using technology, is very important and I think should be maintained. We also saw that technology could be used to help people stay in nursing homes instead of getting transferred to a hospital, and then risk disruption of their medications, disorientation. And so we are very much supportive of using technology and really encouraging us to adapt laws that acknowledge that technology has really promoted the safe and effective use of services by all Americans. And then finally, one area that we're completely interested in working with is in Medicaid. And that is to acknowledge that only 4% of Medicaid populations across the country have access to telehealth services. And yet we all know that we can get services on our phones, and Medicaid populations, 95% of them have smartphones or access to phones. And so we really support the idea that Medicaid adopt telehealth in a more expansive fashion, recognizing that states, many of them are going to be under severe economic pressure, and yet telehealth can be a very cost-effective and very affordable way to provide services to greater numbers. The only other say I'd point out in for your consideration is that we do not think you need to have an in-person visit in order to establish a physician-patient relationship. And so again, I encourage you to consult our website, and again, feel free to contact us as you go through this process. And again, Madam Chairman, thank you so much for your time and consideration. We know there are a lot of brave people in New York, many of them members of the ATA, and so appreciate everyone's effort in keeping us safe.
Thank you so much. We have AHIP next. I think they're on Zoom. Is there a representative?
Yes, Madam Chair, this is Brendan Papard. Thank you for the opportunity today. I did have the chance to testify at the interim meeting and appreciate that. I provided some detailed testimony at that point, and we also submitted a comment letter and a red line of the model, which we hope will be helpful. So I'm not going to go into a great deal of detail here today, but I am happy to answer any questions that you or others have. I want to reiterate that health insurance providers are and have been supportive of the use of telehealth to provide access and reduce costs. We think that this is a good thing, and we've been pleased to see the increase in use. Now we've heard testimony about that, and we think it's a good thing. In order to move forward following the pandemic, there are a number of things that can cement the positive changes that we've seen. And I commend you, Madam Chair, as a sponsor for including a number of these things in this model. First, during the crisis, many states lifted, as we've heard Director Cameron say, lifted restrictions on practicing across state lines. And physicians' ability to work across state lines is determined by the state where licensure is granted under normal circumstances. And you have a provision in here in Section 5, which appears to address this situation, and we think that's a very positive thing. Next, and again, Director Cameron talked about this a little bit, inconsistent state regulations, restrictions or mandates relating to types of technologies, services, or specialties, and we just heard or originating sites, limit health insurance providers' ability to design benefits that meet consumers' needs. This model has several provisions allowing flexibility, including broad acceptance of the various technologies and types of providers who can offer telehealth services, or at least that's the way we read this. However, there are some provisions, and this wouldn't be a HIP testimony if I didn't come with some concerns. And one of the things I talked about during the interim meeting was that we believe, as just noted, that health insurance providers should have the flexibility to design benefits. And there is language in this model that limits this flexibility. Most of that is in Section 4A, B, C, and E. We are concerned about requiring particularly equivalent telehealth and in-person payment rates. This eliminates the cost-saving potential of telehealth and can create inadvertent disincentives, which we've testified to. While payment parity made sense during the pandemic, and it made sense because, again, to begin with the closures, doctors' offices were closed, people could not go to their doctor. This was the only way they could receive services in many instances. It made sense to provide a revenue stream for the providers and to allow access for our members. And even now, as has been stated, many individuals are still reluctant to go to their doctor in person. And some of those people have good reason not to, if they're immunocompromised or have some other concern. However, post-pandemic, I think it's important to look at what we're setting up as a structure going forward. Telehealth visits do not require the same level of intensity, same amount of time often, or the same equipment as in-person visits, and should not be required to be reimbursed equally. We've heard that providers cannot provide telehealth unless there's equivalent payment. We've heard this in other instances. But I would point out that providers are not required to offer telehealth. We encourage them to, but they are not required to. And there are providers that we have negotiated with as an industry who are willing and able to offer the services at our negotiated rates. And that redounds as a benefit to our members. We also agree that telehealth should not become a replacement for needed in-person visits. And we don't want to create inappropriate incentives to substitute a telehealth visit for a necessary in-person visit. And I think you've seen, I testified to this last month, but I think you've seen subsequent media coverage of this. We've seen a drop in vaccination rates, and that is a tremendous concern to our industry. And I think it's a concern to the provider community as well. And we want to encourage people to go in and get their vaccinations. If we create disincentives, that's just one example, but we don't want to create any disincentives to have people go visit their doctor when they should. Our recommendation is to allow flexibility in negotiating appropriate payment rates for telehealth services. Again, this is post-pandemic. These savings from negotiations can and do benefit our consumers. The explosion of telehealth under COVID has provided opportunities and raised new questions. Ultimately, the growth is good, and health insurance providers have been providing telehealth coverage for a long time, and we're pleased to see this growth. Again, I want to thank you for the opportunity to testify today. If there are questions, I'm happy to answer them. If you specifically have questions about the red line that we sent you, I'm happy to talk about them. Thank you.
Thank you. We have next Kim Horvath from the AMA. Kim? Are you muted? Okay. While we're getting that set up, I want to offer an opportunity for my colleagues to ask any questions. If there's people in the queue, I don't know, I can't see the Zoom, but if people in the queue have their hand raised. If Kim comes online, we'll get to her, but let's start with questions. Senator Hackett, you can go first.
Yeah, thank you. I tell people in Ohio about 5-6 years ago, we brought telehealth and we were able to sell the business community by saying it would be a lower reimbursement. But saying that, I really compliment the plans during the crisis about paying in how, and I think everybody's agreed. But one thing that, you heard the commissioner talk, and we see the same thing in Ohio, and a huge amount of telehealth, a lot more than anyone projected is, but also combine that with a number of people that normally go to the emergency room are not going to the emergency room. And so there has been tremendous savings to the plans, and that they're not paying in nursing room and emergency room visits as they normally would. So the issue really comes up, but the only thing, and so I always supported telehealth, but I always supported the lower reimbursement. But maybe I'll change. But the only thing that bothers me, and I'd love to see a question, is all the providers will say is, yes, telehealth can be delivered at a cheaper price. So where do they say, I mean, what about the consumer? Why doesn't the consumer share in the savings? So that's the question I ask. If they can do it at a lower price, why shouldn't the reimbursement? I agree right now during the pandemic, it's worked tremendously. The plans have been great. But when we look after the pandemic and we know that the cost of telehealth is lower, and I agree with what this lady said, I've had 4 telehealth visits. Every one's been on my iPhone, and it's worked tremendously onto that scenario. And so that's the only question I have to the providers. Why, when they know it's going to be cheaper, why do they expect the same reimbursement?
Okay. Senator Hackett, we're going to have Kim Horvath from the AMA speak.
I'm sorry.
And then, no, that's good because she might be able to answer your question during the delivery of her testimony. And then I think AHIP may want to have a response for your comments as well. Kim?
Hi there. Thank you, Chairwoman Hunter. I'm sorry I had the timing a little bit off, but thank you all. It's a pleasure to be here today on behalf of the American Medical Association to share our thoughts on the NCOIL Telemedicine Authorization and Reimbursement Act. I did hear the question, the end of the question, and I will do my best to answer it. But first, let me provide some of the other remarks that we wanted to make. As you all know, this is an exceptionally important and timely issue, and we appreciate NCOIL and the Health Insurance and Long-Term Care Issues Committee for bringing forth this model bill, which includes many of the key provisions to ensure expanded access to, as well as coverage and payment of telemedicine. There are 3 key points I want to focus on today. One is payment, so stay tuned. But the first is coverage. And just want to make sure that you all are aware that the AMA supports the language in the model expanding coverage of telemedicine. We believe telemedicine can and should be integrated seamlessly into the delivery of healthcare. And when clinically appropriate, telemedicine is just one of the ways in which care can be provided to patients. Therefore, coverage of services provided via telemedicine should be on the same basis as comparable services provided in person, much like that visit that you had over your iPhone. What we have absolutely learned over the past 6 months is telemedicine cannot and should not be viewed as a separate and distinct service, but rather, again, just a way in which physicians can provide care to their patients. Likewise, we believe patients should be able to access services via telemedicine from the same physicians who provide their care in person. And they should be able to do so without barriers or different cost sharing structures as other telemedicine providers. And we strongly encourage the committee to include language in the model bill to protect this construct. Our letter to the committee describes some specific parameters for your consideration in future potential iterations of the act. And we believe these are really important to ensure both protecting the patient-physician relationship and also continuity of care. And finally, payment. Physician practices across the country have made and continue to make significant investments, both in terms of time and money, to adopt and promote access to telehealth services and telemedicine services for their patients, particularly during the pandemic. I mean, we have ramped up just in a very short period of time the number of physician practices that are providing telemedicine to their patients. And it's not going away. We realize that. Many recognize and don't want it to go away, both patients and physicians alike. And so we will take efforts to make sure that that does not happen. But these practices should have certainty going forward that their investments are sustainable. And we know that telemedicine has been instrumental in making sure patients have access to care during the pandemic. It has been vital for many patients in the pandemic, including vulnerable populations. The AMA supports fair payments to further the advancement of telemedicine and believes services provided via two-way audiovisual telemedicine are commensurate with in-person services, and payments should be the same. With the increased use of telemedicine over the past 6 months, one of the things that we do have is the ability and opportunity to collect data that will really help inform potential savings associated with the appropriate use of telemedicine, but also fair payment. So a lot more to come and a lot more to discuss on this. And I hope that we can continue to have those conversations with the committee and forums like this. So I'll stop there. And again, we just look forward to continuing this conversation and continuing to work with the committee. Thank you.
Thank you, Kim. Perhaps yourself or someone from AHIP would like to directly answer the senator's question relative to potential savings if we don't have parity, or if someone is on their telehealth call, exactly why should that be equivalent to an in-person visit?
So I can take a first stab, and I think that when we're talking about audiovisual telemedicine, that is commensurate with what you would have as an in-person service. Again, we are working on collecting data to help inform those potential cost savings. We don't have it yet, but we're working on it, and we'll be more than happy to share that with the committee. Again, the past 6 months, we've seen such an increased use of telemedicine, and we really do have a unique opportunity now to be able to gather that data and have that information that would be more than happy to share with you.
Chairwoman, I will, if with your permission, I'd be happy to provide some additional commentary.
Go ahead, you have the floor.
Yep. To the point, most carriers who design these benefits do in fact provide a reduced cost share for telemedicine use. And so there is already a savings for the consumer immediately built in. To the point about decreased emergency room use, we always want to see decreased emergency room use when it's not an appropriate emergency room visit. And if this is a way to prevent that, we think that's terrific. And as I said during my testimony, we have providers who are willing and able to negotiate with us to provide these services. And so it is a benefit that is going to be available for our members. And then I just would ask, and I know Kim stated they're working on data, but I just say, if you get more of something and pay more for it at the same time, I don't see how that reduces costs. And so I would just challenge them on that point.
Are you finished with your comments? I guess you're muted.
I am. I'm sorry, Madam Chair. Yes, I'm happy to say anything else if that didn't answer the question.
Okay, thank you. Senator Hackett, did you want to follow up from your original question before we go to Ms. Johnson? You good, Ms. Johnson?
Yes, thank you, Madam Chairman. I just want to add to the conversation, and we work closely with the AMA and AHIP on many of these matters, that the ATA, again, representing our broad, diverse membership, we really support fair payment that's commensurate with the investment required by telehealth providers, recognizing that telehealth can be audio only, audio visual, but also can be remotely provided. And there is a fair amount of work and costs and investment associated with that.
Thank you. Representative Ferguson had a question.
Now, can you hear me? I'm sorry.
Yes, yes. go
Oh,
ahead.
yeah. I actually have a couple of comments, and maybe if the panel could respond. Telemedicine, for one thing, I mean, if you talk to your physician, I think that they will tell you telemedicine visits actually take them a little bit longer because of the video aspect. It takes them a little longer to negotiate the visit. So I think that supports parity. But I think we all need to understand that telemedicine has evolved into sort of three separate things. You have your doctor to specialist, which is like our stroke centers and all of those kind of doctor to specialist, hospital to specialist services, which are great. But in terms of the doctor to doctor aspect of telemedicine, that has also evolved into two separate things. You have your big telemedicine providers like Teladoc that contract with primarily ERISAs or big companies to provide telemedicine services to employees. And then you have this separate telemedicine that has evolved, I'm very thankful, during the pandemic, which is standing up doctors' offices to do telemedicine with their own patients. So I have a real concern that these big telemedicine companies are contracting with ERISAs or insurance companies or employers, and they're actually going to circumvent the patient's own provider and require the telemedicine visit to be with the big telemedicine companies and not with the patient's own provider who may have telemedicine services available. We looked at some problems in Arkansas where it actually was going to reduce access to rural health care because a telemedicine provider from a hospital was going to come into an area and provide services where there was the only doctor in the county was right across the street. So, I mean, that's a real concern. Two things: that you don't circumvent the patient's own provider, and that this might actually reduce access to rural care if you're driving these patients to telemedicine away from the only rural provider. So maybe the panel could comment on that.
Ms. Johnson, do you have any response?
No, I would say that we support and understand the concerns about the use of telemedicine. We think that it is health. Telehealth is health. Telemedicine is medicine, and we view it as another modality of care. In rural communities where organizations like Avera eCare operate in the Dakotas and in 30 other states, what they've done is really support rural physicians who have not been able to sustain their practices otherwise without this technology. So we think when it's deployed in a reasonable fashion, that it really ends up supporting physician-patient relationships.
AHIP or AMA, do you have any response?
I'll just restate what I said during my testimony, which is we do not believe that telehealth should become a replacement for in-person visits when they're needed. And so I agree that would be a concern if telehealth developed in that way. But I don't know the specifics of that circumstance, so I certainly couldn't speak to that.
And if I may, the one other point that I will just kind of layer on to Representative Ferguson's comments are that often with telemedicine, you don't always know, and physicians nor patients always know at the beginning of that telemedicine visit whether that visit will necessitate an in-person care following that service. Not everything can nor should be provided via telemedicine, and not every patient should or can receive services via telemedicine. So I think that's also important to make sure that the committee understands. Thank you.
Thank you. You know, obviously all things are not created equal, and not having some reliable access to broadband and Wi-Fi has really hindered some people being able to have access to telehealth. I think that while many people do have smartphones, the capacity to be able to take that step further isn't always there. We see that with education now with remote learning, that it's just not always available, even though we think it's so simple and everyone has a phone. I do have concern personally, obviously, about the requirement for in-person meetings. You see somebody over the phone, but you're not able to hear their heartbeat and, feel their glands if they're swollen or something. So I think that we need to really make sure that care really is being given, and it is obviously not all equal and access isn't the same. We're going to continue obviously to work on this model. This is not the last that we're talking about this, but do any of the other legislators have a question before we move forward on the agenda?
And Madam Chair, this is Director Cameron. May I make a comment on Representative Ferguson's question? You bet. And first of all, the NAIC is studying these issues like you are. Our committees are reviewing them, and we don't have a firm position from an NAIC perspective. But I thought I would share just some of the experience that I've seen in my state. By the way, I am a patient of telehealth services. I actually kind of comically had to do a telehealth visit with my dermatologist in the Capitol building, the men's restroom of our Capitol building. So it was quite the experience. I think the concern, and I think Representative Ferguson hit on it very carefully, that I think has to be considered when you discuss parity. Certainly there are additional costs associated with standing up telehealth services, but there are savings that are also occurring when a physician is able to provide telehealth services. I realize that there's some models that will take some time to address. All of our carriers prior to the pandemic had telehealth services, but they were with many of some of the companies that were mentioned earlier, that WebMD and DocMD and MD Live, etc. I don't think we want to encourage that we necessarily go back to just those options. And so we've got to have this balance between encouraging the use of local doctors and helping the local doctors stand up their services. But at the same time, if there's not some commensurate savings for doing so, it will naturally force the carriers to contract with those that are out of state and not the across the street physician. And I think that's a very valid concern that Representative Ferguson expressed, and one that I think we should be careful about as we navigate this road.
Thank you. We will continue to work on this, and hopefully we'll have another updated version of this model for you all to take a look at in December. Thank you, panelists, for your comments. Thank you, Ms. Johnson, for being here today as well. We are going to move forward to the Dental Care Bill of Rights Model Act. So if we could have Chad or any of the rest of the panelists come forward. And Representative Ferguson, if you want to start with some comments before the panelists, you have the floor.
Oh, thank you, Madam Chair. I would like to say a few words before we begin. As you know, we started this discussion on the model bill in December of last year, and we've had a very productive dialogue since then. Since our meeting in March, I've made some changes to the model, which you can see in your binders. I think they start on page 270. First, the title has changed from Patient Dental Care Bill of Rights to the Transparency and Dental Benefits Contracting Model Act. The main reason for that change is that the first draft of the model started out with 5 separate substantive sections, each addressing a separate issue. But I've decided to remove the sections dealing with the retroactive denial and the medical loss ratio because they seem to be the most controversial. as I believe those issues are complex and maybe they warrant their own separate discussion and separate model law. Accordingly, given the removal of those sections, I think the new title is probably more appropriate. I'll just note that the medical loss ratio and the retroactive denial sections were not necessarily removed because of their substance, but rather in an effort to make this model more concise and make it easier for the committee to dedicate sufficient time to each topic. 3 topics is already a lot, I know, to understand and digest in the small amount of time we have. Before I close, I would also like to note the sponsor's note that appears in the latest version of the model at the top of page 1. It states that this model remains a significant working draft. Specific language for modification needs to be resolved and will continue to be discussed. I think that note is important because while I appreciate everyone's work and input on the model thus far, we still have a lot of work to do on the bill. I'm confident that we can get together on this. I'm proud to sponsor the model and I look forward to discussing and developing it further. And I won't take any more time right now. I'll turn it back over to you and the panel, Madam Chair. Thank you.
Thank you so very much. And we have received a lot of back and forth about this model over the last several months, and we'll continue to work through this, obviously going towards December. We have Chad Olson here as the Director of State Government Affairs from the ADA. If you would start your comments, please. There you go.
It's that light that turns on, right? Hi, everybody. Again, I'm Chad Olson. I'm the Director of State Government Affairs at the American Dental Association. I want to thank this committee for hearing about this model again. I want to thank NCOIL for holding a meeting. It was like an archaeological dig, finding the suit to put on, brushing the dust off. So thank you for that. I'd also like to say a special thank you to Representative Ferguson, who just spoke, and Representative Kaiser from North Dakota for being the sponsors on this model and the issues that it brings forth. So, it's no secret that health insurance is confusing, and dental insurance is no different. Our feeling is that patients deserve a dental plan that protects them, removes rather than creates financial uncertainties, and is clear about what is covered and how to properly use that coverage. Representative Ferguson went through some of the adjustments that have been made to the model. I'm sure this committee can appreciate that we're working toward getting to model language that represents more of a cohesive stakeholder input version. And so we're looking forward to continuing that work. I'd like to address the 3 issues that remain specifically. And again, these are transparency in dental, these are network leasing, prior authorization, and finally, virtual credit card payment, all under the umbrella of transparency. So the first is model language to establish fair and transparent network contracting. Insurance carriers occasionally lease or rent in-network relationships they have established with a provider to another entity, such as another carrier or a third-party payer or an administrator. So this can be problematic when both the patients and providers don't know exactly what's going on. If this approach is not done in a transparent and fair manner, it can erode the patient-provider trust, which can lead to wrong assumptions about the treatment plans and the costs, et cetera. Let me give you a case in point. We had a New Jersey dentist who had signed into a network in the 1980s. He reported that perhaps 1 or 2 subscribers had actually come through his office under that network umbrella. About 5 years ago, that network relationship was rented to a very large carrier in the area. He found out about this because a patient said, "Oh, thanks for joining the network, doc." No notice was given to the doctor. A large portion, he found out later, a large portion of his patient base was now in network without his knowledge. He was not able to get out of this contract relationship for 90 days. So he had to accept that discount for 90 days and then had to, because he chose to not be a part of it, had to then inform all of his patients that he was removing himself from the network. You can see that it ended up costing him almost $100,000 when all was said and done. This is a situation that a doctor and a patient should not be put into. So that's the kind of scenario this model tries to address. Network leasing legislation would, what's in the model, would expand transparency before networks are leased and provide an opportunity for providers to review the contracts and then accept or refuse them. To that end, I would like to address some of the comments that were submitted about the provider dentists, that they should not have the right to opt out of rental networks if their carrier contracts indicate that the network relationship can be sold, kind of like that 1980s scenario I laid out. This opt-out right of the dentist is an essential part of the model and preserves an appropriate balance of power between the providers and the carriers maintaining their networks. Without the ability to opt out, dentists will be at risk of signing on to pretty much every network when they sign on to one network, particularly because carriers frequently operate from a take it or leave it situation when they present the contracts. There's not the ability to cross out some lines with when you're signing a network contract with a dental carrier and say, I would like to sign into your network, but just not this leasing portion. That right is not given. So as written, the model language makes a clear distinction, and this is important, between dental insurers and dental network leasing companies. So if a dentist agrees to sign up with a dental network leasing company, the dentist should reasonably expect that he or she is going to be leased. That said, a dental benefit insurer or a carrier is a different kind of entity, often wielding significant market strength in many states. To allow the dental insurers to use a take it or leave it approach when they lease their networks, it would make it very difficult for a dentist to opt out, particularly in areas where the carrier's network strength is very strong, because the provider would lose their in-network status and perhaps put a significant portion of their patient base at risk. So that's where we're at on the model language on leasing. I'm happy to answer questions about that after my comments. Next before you is language concerning prior authorization. So as early as possible, patients and dentists should have a clear understanding of what coverage a patient has and what a patient will be financially responsible for as a result of healthcare services. Insurance carrier documentation issued prior to a service being provided, and often it's called prior authorization, should accurately communicate the amount the carrier will pay. Doing so leads to transparency for the patient and allowing for better treatment planning for all involved. If an insurance carrier has issued a prior authorization, our view, and that's what the model reflects, is that state law should require the carrier to stand by its commitment to pay. Prior authorization is essentially a pre-submitted claim for treatment, usually with diagnostic notes, x-rays, or specific procedure codes reflecting prescribed care. State laws requiring health carriers to honor prior authorization will prevent surprise billing, which we all know can lead to devastating effects on families and patients. So the third issue is virtual credit card payments. So what is a virtual credit card? It sounds like something high tech. I mean, we just talked about telemedicine. We're in a high tech environment now, so a virtual credit card. When reimbursing dentists on the claims they pay, some carriers send a series of numbers to the practice. When entered into a credit card terminal or designated website, this releases funds to the dentist as a payment for claim. Like any other credit card transaction, there is, of course, a processing fee associated with these virtual credit card payments. This can range from 2.5 to 5% of the payment amount. So what does this basically mean? If you have a dentist office that's accepting, say, $500,000 a year, virtual credit card is the only type of payment that they're accepting. The dentist office ends up paying $12.5K to $25K in addition in fees for accepting that money. So what the model does is it says that this can't be the only option that the insurance carrier gives to the dentist to accept for payment. There needs to be others, such as direct reimbursement, maybe a cut of paper check. It's basically about providing options. The model language would also ensure that a dentist is informed if there's a profit sharing arrangement that has been set up between the virtual credit card company and the carrier. If the carrier is receiving a little percentage of the fee the credit card company is charging the doctor for cashing the payment, this information would help the dentist to decide whether or not to accept this as a form of payment. Again, what this model is prescribing is a simple notice of the arrangement. It's not a detailed accounting of what percentage the insurance company is collecting if the dentist is collecting the fee. So those are the three issues. I want to thank you all again for letting me testify today. and dusting off my suit, as I said. I'm eager to answer any questions, and gaining the support from NCOIL for these policies, it would be a great step forward. All three of these issues have already passed some version of them, a lot of them very close to what's in the model language around the country, maybe in some of your own states. So I'll stop there with my comments, and thank you again.
Thanks, Chad. Next up, we have Arthur Bagiance from the National Association of Dental Plans. Is he available for comment?
Yes. Hi. Thank you so much, Madam Chair. Madam Vice Chair, members of the committee, I hope you can hear me okay. Please let me know if not. My name is Arthur Bagiance on behalf of the National Association of Dental Plans. We appeared in opposition to this bill back in March in its original form, and we continue to have some concerns that I'll mention, but we do appreciate the committee considering our feedback up to this point. We realize that this is a work in progress, and we hope to continue working with you if this bill does move. I think our main point today is we believe that all of these topics should not be combined in the same bill. Bills at the state level generally don't do this, and we think for good reason. These are very different topics, as Chad was just mentioning, network leasing, prior authorization, virtual credit card payments. These are unique issues with unique characteristics, and we think they don't have much in common. So each of them, frankly, is complicated enough to require some individual treatment. We worked on these issues in multiple states, and we kind of know this from experience. For example, the network leasing bill in New Jersey that we were involved with was enacted in 2019 and took over a year of work alone. Earlier this year in Arizona, there was a prior authorization bill kind of similar to this, and it had to be actually withdrawn from legislation and assigned to a study committee because of issues that were raised with it. So I think it's still going through that process as we speak. So we think combining all of these topics into one product could create problems. With that being said, we recognize that of all of these issues, it seems that network leasing is probably the primary one. So we would recommend that this committee consider narrowing this bill to focus just on that issue, which we think would be a cleaner, more precise product. NADP and AHIP and ACLI submitted legislative language to the committee that does this, and it's based on the leasing laws in New Jersey and California. Those laws are the most strict and extensive in the country, so we think that's one good reason to look at them as a potential base. That's not to say that you have to use that language verbatim, of course, that you could make improvements and tweaks as you deem necessary, but that was our starting point. And the other reason we looked at New Jersey and California is that in our experience, those laws were very well vetted. They came about after a lot of deliberation and input from stakeholders. And we were involved in that process, and I can tell you it came down to considering individual words and commas and that level of detail. So as I said, the New Jersey bill in particular took over a year of this kind of back and forth between providers and carriers. So for that reason, we think that language is a better base to use rather than doing something more new, at least with regard to network leasing. And then as a final point, I would just say that if the committee does decide to move forward with this bill, we're committed to working with you and helping you to make this a good product. We routinely work with dental associations and legislators in the states where these issues come up. And we usually have a very good dialogue and understanding with them. So we think we could certainly do that here as well. So I really appreciate your time, really appreciate the ability to participate virtually, and I'd be happy to answer any questions.
Thank you, Arthur. Karen Melkertzup from ACLI next. Karen?
Hi, good morning, Chairwoman Hunter. It's nice to see you virtually. Sorry we can't be there in person. I'll be very brief. I will just say we concur with the NADP and Artur's comments on the need to break this up into perhaps 3 separate models and work on them individually going forward. And we did also sign on to we're part of the development of the network leasing compromise that we put forth in March earlier this year, but also concur in Artur's comments that we will continue to work with Representative Ferguson and the ADA on perfecting this if indeed it's the wish of Representative Ferguson to move forward with a combined model instead of 3 individual models. We thank you very much, Representative Ferguson, for the changes you have made thus far, and we look forward to working with you and hopefully getting to a conclusion either later this year or soon thereafter. Thanks.
Thanks, Karen. And we have someone from AHIP speaking
Yes,
to this
Madam
model.
Chair, it's Brendan Picard again. So I'll just simply say, once again, thank you for the changes that have already been made. I'll echo both Arthur and Karen's comments that we still believe it contains some disparate components. And we believe that focusing on the leasing component, which seems to be getting the most attention, is appropriate at this point. We did submit the red line language earlier, and we continue to support working on that. And we appreciate the sponsor's willingness to continue to work. I'm happy to answer any questions. Thank you.
Thank you. Do we have any questions from our legislators here today about the model? No one? Okay. Representative Ferguson, did you want to make some conclusionary comments? It seems that from the comments from the panel, there's some work to be done relative to this model. And just like to get kind of your closing thoughts about.
Like I said, I think we've sort of reduced it down to what I thought was not as contentious. And any model legislation, the states are going to take whatever part they want. I mean, many of these things we already have passed in Arkansas, for instance, in lots of states, so they can separate them themselves if they already have passed legislation regarding certain components of it. The credit card part, we passed this bill in Arkansas because most payers pay with electronic fund transfers. It's really kind of the smaller insurance companies that want to send you these credit card reimbursements, and then, like I said, they receive a part of it, or and then the provider has to take the percentage out, just like running any other credit card. So it just says you can still take them if you want. You just have to, but you have the option to opt out. Where sort of the leasing component came in Arkansas, as many of you know, Arkansas passed Medicaid expansion with private insurance. So particularly with Blue Cross Blue Shield, who's our biggest provider in the state, they were requiring you to participate in all products. In other words, Medicaid expansion under private insurance paid significantly less, but you were required, because you were a participant, to participate in all their products, and they could. So it's a similar problem with leasing. You don't want to require a provider to accept lower reimbursement if he hasn't contracted to do that. So I think it's a reasonable bill. And like I said, legislators can always take the model back and separate it however they like. But thank you for your time.
Thank you. We will continue to work through this, obviously, and see this model hopefully to conclusion in December, as we have a little bit more time left to keep working through. So thank you, panelists. Thank you, Chad, for being here today. We're going to go into our last discussion, which is the Vision Care Services model, with Senator Hackett being the sponsor. I believe Robert Holden is here in person, and we have a couple folks on Zoom to participate on the panel. Senator Hackett, did you want to give a couple comments in advance?
Yes, and I appreciate it. And I do feel it's important to give a little background on our model legislation. Just to let everybody know, Ohio is one of the states that we couldn't get the non-covered dental passed in Ohio, no matter how hard the dentist pushed. And I feel the Ohio optometrists saw this, and they worked with the vision plans to get the legislation passed. Both sides gave, and they met in the middle, and they hammered out quality legislation. Here at NCOIL, we have not been able to get the support of the National Optometrists Association. They'll be here to speak. And even though the vision plans have agreed to allow the optometrists to stay in the network, even though they do not offer discounts on the non-covered items, the National Optometrists Association will not support the model. And it's actually because, Tom and Will tell you, it's because of one issue. When the plans list on their website who is in their network, they also want to list which providers will offer the discounts on non-covered items. And in the question we said, shouldn't the consumers know who will offer the discounts and who won't? And so that's what the issues come down to. So we're working with the association. We've asked them if they could provide us with language. It's something they could accept, and we haven't got that yet. I want to thank NCOIL and their staff for their work on the bill, and thank you for letting me say a few words. Thank you.
Thank you, Senator. Mr. Holden from the National Association of Vision Care Plans, if you would, please, sir.
Thank you, Madam Chair. My name is Robert Holden. I'm here on behalf of the National Association of Vision Care Plans. I do have some slides. We can put that up here. Thank you. Just to follow on some of the things that Senator Hackett had said, this is a consensus bill that came out of the state of Ohio. Subsequently, we've worked with Representative Dunnigan in Utah to pass similar language, and we're currently working with Senator Livingston as a co-sponsor of language in Arizona, which made it through the House this year, but due to COVID and other issues, wasn't able to get through the Senate. And I think it's important that NCOIL consider this bill because there has been some confusion based on a previous model that has passed, as Senator Hackett mentioned, in a number of other states addressing the idea of uncovered dental services and its application in the vision industry. So I'd like to talk about some of those differences between the two industries and why we're very pleased to have come to consensus in Ohio and elsewhere on this issue. There are a number of differences between how vision benefits and dental benefits are offered. Unlike a dental plan, vision plans offer really only one healthcare service, and that is an annual eye examination. It's routine care, it's preventative care, it's valuable care, but there's really only one major healthcare service provided. And it has many component parts, but it's a relatively simple benefit from that perspective. The complexity comes in when we talk about coverage for the purchase of eyewear, and in that way, it really shows the difference between dental plan benefits and vision plan benefits. When a patient receives that annual eye examination, our plans are based on the model of encouraging them to purchase eyewear from their provider. We think they get much better service from that perspective. We think it deepens the relationship, and I'll talk to you later in these comments about some additional benefits that provides to the patient if they go to a vision care provider who owns their own dispensary. But as I said, there are some complexities to that. One is that there are a whole host of options available to the patient. One is from a non-medical side. They have a number of frame options available to them to suit their preferences, but also with respect to the actual lens, the medical side of it, there are a number of options. Some of them are important for purposes of improving their vision. Others are simply preferences as to the lens. So, for example, lens materials can be selected. While our plans typically cover single vision, bifocal or trifocal, they may prefer progressive lenses. They may want tinting or anti-reflective coating. There are just a lot of different options that are available to them. And then, of course, patients have the option to not purchase from their provider. They can go elsewhere to other retailers to purchase that. So this draft model really reflects some of those critical differences from our perspective. One is that they define vision care materials to distinguish materials from services. Also different in vision plans as opposed to dental plans. There are two different provider types, one optometrists and others ophthalmologists, medical doctors. And so those are both equally treated in the bill as vision care providers. The bill also places requirements on plans. One is, and this was really the major compromise that we worked through in Ohio, the idea that vision plans would be prohibited from setting prices on non-covered services and materials as a condition of joining the network. And this represented a compromise because essentially it made participating in any kind of plan pricing optional to the individual provider, but allowed them to be a preferred provider within the network in every other sense. And so while our plans would have preferred to have a consistent benefit, we were able to work through on that compromise. But what that made critical is some of the patient protection provisions later on in the bill. Additionally, the bill also provides and guarantees that providers can describe all options to the patient with regards to services or eyewear. So even if a particular eyewear type is not covered or is differentially priced, again, there's no restriction on their ability to offer that through their own dispensary. The patient protection components of this bill really, as I mentioned, are very critical because the patient needs to know that the pricing can differ if that provider has opted out of plan pricing. And that comes up in two ways. One of the things that our plans do is to negotiate a discount on a second pair of frames. Once our enrollees use up their benefit for the year, they really have no reason to continue to shop with the provider on price. We want to continue to encourage them to go to their doctor and purchase eyewear from them, again, as a second touch point during the year, or just to make sure that that second pair of frames properly suits their medical needs. And so we've negotiated discounts on that. Under this bill, those would be optional. But again, we want to be able to tell the patient whether or not those standard price discounts are available. The other component of this is something that is related to the lens options. All of our plans cover a basic lens, a single vision lens, or a bifocal lens. And as I mentioned, there are different options that can be provided on top of that. And so if a patient chooses any of those options, that's usually paid through a copay. And that copay is offset by the cost of the lens, but the remainder of that goes to the provider in addition to a dispensing fee. We're concerned because under some of our discussions here, and as has been borne out in studies, some providers consider that non-covered and then do not put a limit on that pricing. Our concern there is that a patient thinks they're getting a covered lens and a covered option, and before they know it, there's a large increase in the out-of-pocket cost for them with their provider. Again, we want to have the ability to provide them with information on that before they go to that provider. And then also we think it needs to be reiterated at the point of service. So finally, and I'll end with this, there's no doubt in terms of the studies that we've run and also other studies that there is a tremendous value to patients going to see their optometrist or ophthalmologist and purchasing eyewear from them. They're far more likely to get that examination every year if they're going to purchase eyewear. And even if they go specifically for the eye examination, again, they're more likely to purchase that eyewear than if they don't have that benefit. So we think combining those benefits is a great deal of value to the patient, also to the provider. And we think that this model bill is a great compromise in providing not only flexibility to the provider and the plan, but also providing transparency to the individual consumer. So thank you very much for the opportunity to make comments, and I'd be pleased to answer questions.
Thank you so much. AHIP, you're up. Brennan, is it you again, or?
It is indeed.
All right.
We agree with the points that Robert just made for the vision care plans. The model, as we've heard, is a product of compromise and consensus. To that point, we need to be able to provide information to our consumers, our customers, so they know what their benefit is and what they're looking at. This is a consumer protection and consumer interest model. We did submit a request for a clarifying and simplifying amendment. We believe the additional sentence at the end of section E is not necessary, and the provision reads more simply if that second sentence is stricken. So I'll just say that again. I know there are larger negotiations going on with the bill at the moment, but that we do believe that's important. Thank you.
Thank you. And then we have a representative from the American AOA. I have my glasses on here. Oh, Daniel Carey, sorry.
Yes, ma'am. Thank you, Madam Chair. Can you all hear me okay? Okay, I'll go ahead. Well, and if you have problems with the glasses, I know we could probably find you someone there in New York locally who could help you out with that. I appreciate the opportunity to be here, even though it's virtually. We prefer to be in person, and the opportunity that we've had since the first meeting in March to continue this dialogue and conversation, I think. And I know our members believe this is a very important issue. It's why our members have addressed this legislatively now in 23 states. And we appreciate that dialogue that we've had, not only with this committee, but also with Senator Hackett and NCOIL staff that we've had between the March meeting and in this meeting here today. So thank you all very much for addressing this very important issue. I really wanted to focus on two different areas that we find to be most problematic with the proposed legislation. I know that Senator Hackett, I'll touch on that first, he mentioned it, as far as it relates to notification to patients. We agree that clear communication and notification to our patients and to our members' patients is critical to the care that they receive, to the benefits that they have, and to the payments that they would potentially make. The way that this is listed out and the way that we've seen this play out in states across the country, and the reason that we've addressed this in a number of different states outside of Arizona, Utah, and Ohio, is because ultimately what we see when the plans do list out our members is what we refer to internally, and have mentioned this in committee hearings, is scarlet letter. Our doctors, whether they are offering a full breadth of discounts or if they are offering singular discounts as it relates to the plan, they are held separately and ultimately problematically to the doctors who fully subscribe to the plan's discounts that are being offered and those who fully sign on to the contract. And we've actually seen that that's been a problem in Ohio. This has been something we brought up. We had Dr. Gossard from Ohio. She was actually president of the association at the time, who worked closely with Senator Hackett during her tenure as president and outlined those concerns. In practical application, we've seen our doctors have been held out and are not readily available to be viewed by patients when they do log into those portals. So that is one of our concerns. By no means are we trying or do we want to be disingenuous with what these protections or what the plan is offering. Ultimately, we just want to make sure that the patients are being able to find the doctors that are most accessible and can provide the most comprehensive care to them. The other area, section D, that I'll focus on that we found problematic is as it relates to non-covered services itself. These non-covered services are discounts that the plans are marketing where they ultimately have no skin in the game because they are not fulfilling the costs as it relates to these non-covered services and materials. What we're saying is that as it relates to these non-covered services, that we need to define these vision plans. I'm sorry, I'm looking at the wrong section here. That we need to make sure on these non-covered services that our doctors not being dictated to by the market power that these plans bring to place. We have roughly, with the with the NAVCP plans that they bring to play, they have roughly about 180 million individuals across the country who are part of these plans. The issue that we see, and this was actually a conversation I had with some doctors within the last week, is that they wield incredible market power within these states, regardless of the state. One of the doctors I spoke to recently, upwards of 70% of her patients come from the vision plan in her state. So either she is in with the plan or she is not, and the issue is she's not able to opt out of these plans because 70% of her patient base comes from that. So if she can't be found on a website as it relates to notification, or if she weren't to take these discounts as they're outlined here, then she would essentially not be able to practice within her state. So those are the two biggest areas. I do feel as though we found some areas of compromise, section A, and definitions that we've added as it relates to what a vision plan is defined in a state, which does vary. In some other areas, we found some compromise, but we do have some concerns. We've enjoyed the conversation with Senator Hackett. Just a note there, I apologize if there was some miscommunication on our end. More than happy to get back to you all as it relates to disclosures and transparency of our doctors. But do look forward. I know this is a continuing dialogue, and I look forward to having these further conversations so that when we meet again in December, that we could have a more fully vetted and something that would be better represented bill for both the providers, the plans, and ultimately, most importantly, patients. But I look forward to answering any questions from the committee members on this.
Thank you, Daniel. Before we get to questions, we'd like to hear from Dr. Rebecca Wortman next.
Yes, thank you. I appreciate the time, and Senator Hackett, I appreciate all the time you spent on this topic with us. I want to make just a couple of points. One, in one of our conversations that we had, we talked about the need to inform patients of discounts because of the concern that the plans had, providers were going up their prices and charge a lot more or to any plan member for anything that wasn't covered. Well, there is a principle of usual and customary fees that's standard across everybody. It's in most of the state laws that are already in place. It certainly is a requirement under all the federal programs that you charge what you charge across the board to everybody. So there was a bit of scoffing when I mentioned the fact that we do have that standard of usual and customary, and that our providers, our doctors are not going to overcharge patients. What their fees are. That's a number one principle. So the usual and customary should be a sufficient principle to go by. Plans as well should not be allowed to add covered items at nominal fees just to say that XYZ is covered and pay us $1 or $2. That isn't really very fair across the board. So other thing that we plans to do
You're breaking up a little bit. We can't hear you.
is be very clear. My medical, can you hear me now?
Yep.
Okay, I'm sorry. So we do feel like plans should be very clear on what is covered and what is not covered with patients. One of the common reasons I believe as a practitioner, as a practicing provider, is that a patient comes in assuming that they can get a free eye exam and a free pair of glasses. And then when they opt, the patient opts with education to go above what is standardly covered, they get upset because the plans haven't informed them that there's going to be quite a bit of things that might not be covered. The fourth thing I want to mention is that we feel like plans, if they do feel like need to educate their patients, their customers on what is covered and what is not covered in any fees for the non-covered services, that they simply say that there may or may not be other discounts offered on non-covered services. That informs the patient that that's a conversation they need to have with that provider. Patients always have the choice on what they get. Patients are always educated on what their options are and why or they may or may not want those options. So we do a really good job as providers because we're also business people. And as a business person, we want our patients to be happy. We want them to know exactly what to expect and the transparency when they do come in. And with plans leading patients to believe that their glasses are free or they're going to pay $10 or whatever their copay happens to be, that's as misleading as the plans seem to think, us not being willing to have it published whether or not we're going to offer extra discounts on the non-covered services. I think that needs to be an individual provider choice. As a provider and as a business person, we know our markets. We know what we need to do to make our customers and our patients happy, our patients that are our customers happy. And so we're hoping that we can move forward with this legislation and fix this major issue that we have. And I thank you for your time.
Thank you, Doctor. I think we're going to go into questions now. Representative Lehman has a question.
Thank you, Madam Chair. Maybe this is a question for AOA. I'm kind of 30,000 foot view here. I'm hearing multiple examples of where consensus was reached by state associations in the respective different states. But now seems to be this opposition to kind of that same language here. So I'm curious why the difference between am I right on that, Bob? I mean, it sounds to me like you've had some success within the state associations, but now we're not connecting with the national. Is that correct?
And I'll let AOA answer, but the issue still comes down to that we weren't able to get the dental non-covered items closed, and in Ohio passed. And you saw, I think 40 states do not allow dental companies to do that in a situation like that. So that was a question I had for Daniel. Is Daniel, in the 23 states, same thing you do, the 23 states that you have language, is the language is just says you can't be kicked out of the network if you don't, if you don't get offered the discounts. Is that what the language is in the other states? Just mirroring the language that's on the dental.
Yeah, that's kind of my question. Is they seem to be having negotiated that into the states, but not now we're seeing this
But we
opposition.
can't get it done
So I don't
in
know, Daniel,
Ohio.
if you can address that.
Daniel, can you respond to these comments?
Yes, ma'am, happy to. No, and Representative Lehman and Senator Hackett, I appreciate the question. I think, as it relates to these individual states, we've got 3 states, one of which was not enacted, but in Utah and Ohio, where it was, where they did work, and we did support them in their efforts. Ultimately, they didn't end up with the bill that they started with or would have liked as an ideal type piece of legislation. I know in Ohio, for example, and talking with their association and talking with their members, again, the practical application side of it has been problematic with the plans, not only with the listing out of doctors as they're listed on the websites, but also with lab choice, ability for doctors to be able to prescribe out to different labs. That's ultimately best for the patient. To your general question, Representative Lehman, I think as we look at it, we try to best support our states in this legislation. And I know, as you all know, legislation varies from state to state, as do the laws. What we're trying to do is, if we're going to put forward a national model, that ultimately we would like to have something that is most comprehensive and best suits not only the patients first and foremost, but the providers and the plans as well. Which is why I think, and when we suggested the other states, we did send over some to NABCP, to NCOIL, and then also to Senator Hackett, which we thought were not necessarily something that, if I remember correctly, I think Tom had said, was fully one-sided, what we would consider to be our most ideal. But states like Colorado, for example, Arkansas, I know Representative Ferguson is familiar with that. Mr. Holden and I sat across the table from each other in Colorado. So I think states like that, where it encompasses more than just what we're dealing with here, and the language is a little more favorable from our perspective, if we could work towards that and that type of consensus, if we are going to have a national model from such a respected organization like NCOIL, that I think something along those lines would better represent the issue, and would enjoy that opportunity to fully vet that language and go back and forth between now and the December meeting. I don't know if that answers your question, Representative Lehman.
Senator Hackett?
No, yeah, you did. I just still not quite understanding it completely, why there's a disconnect, but we'll have that discussion.
We have a few more months, obviously, to get to December. So hopefully with your leadership, Senator Hackett, you can navigate through some of these differing points of view.
Yeah, and you can see, they have to realize getting in the network is a plus for the provider. They're getting in the network. In the dental, if you don't offer the discounts, you can't get in the network. And we outlawed that, but not all the states, have accepted what in the NCOIL model legislation. So we're saying they are getting a benefit by being in the network. Why can't consumers be protected to say which ones offer the discounts and which ones don't? And you can't blame the optometrists. We have an optometrist in Ohio that probably don't like it. I know that because they don't want their patients to know that they won't give the discounts. So it's not an easy bill, as you know. Thank you. We'll work on it.
Any other questions? Okay. Is there any other business before this committee? Hearing none, a motion to adjourn. Second?
Second.
Adjourned.
Ready to call this meeting to order. The first order of business will be to Asking legislators on the Zoom to identify themselves.
Ken Cooley from California is with you.
Deborah Ferguson, Arkansas.
Edmund Jordan, Louisiana.
Senator Jim Seward from New York.
Is that everybody? All right, will you and I identify who's here for those that are on the Zoom? Oh, sorry.
For Representative Rowland, Assemblyman Cahill, Representative Fisher, Representative Weber, Senator Utke, and Representative Lehman.
All right, ask for motion to waive our quorum.
So move.
All in favor, say aye.
Aye.
Do we need to approve the minutes of our last meeting? Motion to approve the minutes from our March meeting. Second. All in favor, say aye.
Aye.
You said March, you meant July.
Oh, and July. Sorry. Our March meeting and our July calls. Update on our annual meeting in Tampa. Tom, I'll turn it over to you.
So we look forward as we sit here to going forward with our annual meeting in Tampa, Florida. There is a little hiccup there as the state of Florida has yet to pay its dues. And so the officers have instructed us, obviously, not to go forward in a state that hasn't paid its dues. The hotel in Florida is a corporate-owned Marriott, so we've opened discussions with the Marriott Corporation about moving that to a different venue elsewhere in the South. However, we are optimistic that Florida will be paying its dues in such a way to avoid that move. So hopefully, this meeting seems to have been successful. So COVID won't stop us, and a lack of dues payment won't stop us. So we're very optimistic we'll be in Florida, Tampa, Florida, in December, which, by the way, will be our last December annual meeting. As far as the eye can see, we've gone back and taken our traditional dates and are booked out for years to come, and have told the NAIC that.
All right, thank you, Tom. And with that optimism, we'll see you in Florida. Item 3, the 2023 spring meeting location. Tom?
Yes, at a prior executive committee meeting, we were focused on San Diego. We still remain focused on San Diego. Oddly enough, we've had some unexpected trouble zeroing in on a hotel, partly because of some government rate issues. But we have 3 different options where we think we're going to make some progress, right there between the Gaslight District and the Bay. So we'll be in San Diego. We just don't have a hotel contract as yet.
All right, so we'll stay tuned on that one as well. Item 4, administration. Tom, if you want to give us an update on our meeting report, financial report.
Sure. So we had 219 people at this meeting, 91 in person, 128 virtual, 30 legislators from 16 states. 25 of those legislators were in person, and 1 first-time legislator. We had 5 commissioners who participated, 2 in person, 3 on the Zoom, and 9 insurance departments were represented. So I just want to thank everyone. I want to thank everyone who participated. We were very forward-leaning on this meeting and going forward for months. Others have speculated that we were going to cancel this meeting or go all Zoom. We didn't do it. That required the courage and stick-to-itness of all the legislators who decided to come and all the NCOIL participants who decided to come. And it was critical. And just as important as it was for the folks who came and participated in person, I want to thank all the Zoom attendees. And I'm looking at the screen, although you can't tell that, because without knowing there was going to be solid Zoom attendance, it made the actual attendance less certain that we could go forward. Yesterday, I thanked Matt and the officers for all their work so far this year. And additionally, there's some other folks who deserve thank you. You know, Kara from our staff has left, which has really led to some increased burden. The ladies who you see out at the table have really been a lot more than just our meeting prep and meetings staff here. Susan Barros and Marie Scalfani, if you could stand up and be recognized, and your colleague Linda has just really been unbelievable. Our young intern, Pat, has taken on far more than just intern duties, I have to say, both at this meeting and the time leading up to it has been spectacular. I can't say enough. And lastly, I just want to say, if I go out and get hit by a bus, this organization will have an increase in quality because of the fella two down to me on the right. I can't say enough. I can't put into words about the job that Will Malofchik does.
If I can give one more shout out, since you're on the shout outs, I want to thank the guys in the back of the room from the hotel who have kept all this Zoom and technology things going. So thank you very much. I know a lot of that goes unnoticed, but I noticed the times, I know a couple of times Senator Hackett didn't turn his mic off and it threw you guys off a little bit, but that's okay. So thank you very much. But Tom, if you want to give us the financials.
Sure. And thank you for indulging me on that. On the interim financials, the 2020 unaudited financial report through August 31st, we have total revenue of $1,021,853 and expenses of $651,785. So we have revenue over expenses as we sit here of $370,067. So all things considered, we're having a good year this year.
All right, thank you, Tom. We're going to discuss our audit. We do have copies of the audit up here if somebody would want to actually see that. I'm going to kick this to Ken Cooley. Solomon Cooley is our chair of our audit committee. And so, Ken, if you want to maybe touch a bit on the audit.
Yes, indeed. We had our audit was again performed by Collins and Company, and Jim Cunningham took care of that for us. Went through NCOIL's financial statements, also the Insurance Legislators Foundation meticulously. All was in order and met current standards. We noted that when we get the audit next year, there'll be some variation in our finances attributable to COVID, but at this moment can't actually tell what those will be. So everything tracked properly. The one bit of advice organization is, as we have bills come through and approve them and they are approved, we need to note specifically what the approval is. So he had good organizational practice advice for us, but the audits conformed to generally accepted accounting principles and all was in order, and we approved the audits.
Thank you, Ken. I maybe give one maybe kind of specific on that. Was a positive change in the net asset year over year of 95,115. That amount would have been 30,000 higher, but we did make a change in the middle of the last year, shifted administration expenses being borne by the ILF over to NCOIL. And that was because that matched up more what they actually were doing. So that's why you might see the difference if you take a look at this. But it was a clean audit, and thank you, Ken, for working with them and for the NCOIL staff for doing that. Are there any questions on the audit? Okay, seeing none, any motion to accept the administration report. Is there a second? All in favor, say aye.
Aye.
All right. I think we need to also approve the audit separately. So I'll need a motion to approve the audit. A second.
I would so move.
And a
Second.
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 Anderson. All in favor will vote aye.
Aye.
Opposed? All right. We're going to move now to our consent calendar, item 5. The committee reports, including the resolutions and model laws adopted, readopted therein, as well as ratification of decisions made and actions taken by the NCOIL officers in the time between executive committee meetings. You have in front of you, if you're here, you would have got in front of you now that consent calendar showing what the different committees did at this meeting. And so I would only ask if there's any chairs that would want any of those removed. If not, then I would ask for a motion to approve the consent calendar as presented. Have a second.
So move. Second.
All in favor, say aye.
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 Thank you. We'll move on to other sessions. We had a couple of featured speakers. First of all, I want to thank Commissioner White for attending. He had to take off yesterday for his remarks at the welcoming breakfast. We also had Steve Livengood, Director of Public Programs and Chief Guide at the Capitol Historical Society, deliver some remarks at the welcome breakfast. It was very interesting. Frank Donatelli, who had served in various positions in the Reagan administration, assistant to the president, he gave a great keynote, kind of giving us as he put it, a kind of an overview or an opinion, a little bit of what's happening in the electoral, that we're all paying attention to that, obviously. Also, a thank you to Nicole Nason, who was here. She's the administrator of the Federal Highway Administration, and she spoke on the distracted driving. I'm glad that she was here. It'll make me more aware of my texting, and I guess I won't be watching movies on my drive home. So I do have about an 8-hour drive home, and I will be listening to music, but I will avoid video. Also, thank you to Robin Chase, former CEO and co-founder of Buzzcar, Zipcar, that delivered a fascinating presentation on the current state and future of the transportation industry. I thought we had 2 very timely and interesting general sessions. The COVID-19 testing, treatment, and vaccination, that obviously had a lot, very, very timely. Also, the future pandemic approaches to dealing with business interruption. That is going to be an issue we're going to continue to deal with, and we'll get that here in probably a second. But that was just kind of some of the things that went on here during our meeting here. I want to go into some of the other business. We do have a new executive committee member, and I would need a motion to add Michigan Representative Michael Weber to our executive committee.
I'll make that motion.
Bart Rowland makes the motion. Is there a second?
I'd second.
All in favor, say aye.
Aye.
Michael, welcome to the executive committee, and now you're in. You cannot get out. It's like Hotel California. IEC, is there any recommendations from the IEC on topics, general session topics? Russell, you have anything you want to? Not this time? All right. That's fine. We'll continue to work with the IEC on what would be some very timely, interesting general session topics. Last but not least, I would like to announce NCOIL will start the development of a model legislation focused on business liability protection. As we all know, it is very timely during the COVID-19. Business liability protection has been one of the most frequently discussed items, and I think it's the perfect time for NCOIL to take action on this. I believe the P&C committee is the best place for this to be discussed. And in my discussions with committee chair, Representative Rowland, fully supportive and willing to sponsor the model legislation. Representative Rowland, do you want to add any thoughts to that?
Oh, thank you. Yeah, I think it is a very timely topic and something that NCOIL should consider. By the time first of the year rolls around, many states will be looking at legislation. Some states have already passed it, certain versions of it. As Wes Bissett mentioned yesterday, the states that are passing this legislation, it's pretty simple. It's very compact. Sometimes it's no more than a couple of paragraphs and a page. or two of legislation. Idaho's looks really simple. Wes was able to share that with me yesterday. So we have some platforms we can start from. If it, pleases everyone, we could potentially have an interim call between now and December, and maybe have something agreed upon by them if that's not too soon. But yeah, appreciate your co-sponsor, Mr. President, and look forward to the discussion.
Thank you, Representative Roll. I do think this is something I would like to see us have an interim call on, and maybe get some language out so that we have something maybe we can even act on in December, because it is a very timely issue. And we want to make sure we deal with that in that manner. Last couple of things I want to take as a personal note here. I just want to thank Tom and Will and the staff. When we went into this in the spring, I thought this will be a good summer. When we left Charlotte, I thought I can, get to go do some NCOIL stuff. But the one thing I won't have to do is be on a lot of calls. And that's all we did for the last 4 months. So, and I think, really navigated through some really difficult times, and they're still navigating through some difficult times. So Tom and Will, both of you, thank you for your leadership during this time. I'm going to kick it back to Tom. He has one more announcement before we move on for our adjournment.
So this has obviously been an unusual meeting, a groundbreaking meeting in many ways. So more than ever, the meeting surveys are really important. So I'd ask you to fill them out. If you're here in person and you did them in paper, thank you. If you didn't do them in paper and you don't want to, I understand that. And if you're in Zoom, you didn't get the paper, a note went out from NCOIL today, including a Survey Monkey link. Now, when the last time NCOIL used Survey Monkey was just prior to me getting here. And the reason we didn't use it anymore was because we got 4 responses. So we didn't think Survey Monkey was that successful, but it's really the only game in town that we can use right now with the Zoom land. So I really beg everyone to please go on and fill out the Survey Monkey, because we really do need feedback on this, because it's not likely that the December meeting will be 100% in person. We don't plan to make Zoom a permanent feature, but I think in December, because so many companies are still going to have travel bans and some legislators may have health issues and not be able to travel in, we'll need to do it again. So all the feedback, we really welcome all the feedback possible, and you can call or email Will or text us or myself. Happy to get feedback that way. But the surveys are helpful because we can aggregate things and comments as well. And I know the officers want to review folks' comments as well. So thanks very much.
Well, with the drive I have ahead, I'll fill mine out on my drive home.
Oh, yeah, there's box lunch to take with you.
Last thing before we adjourn is there are box lunches out here. If you want to grab one of those on your way out. And outside of that, is there any other business for the executive committee? Seeing none, I would entertain a motion to adjourn.
So move.
Second.
Second.
Thanks everybody on Zoom. Thank you everybody here. We'll see you in Tampa.
Thank you all.